Russia's annexation of the region. Former Federal Reserve Chair Ben Bernanke and two U.S.-based colleagues share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond, and Philip Dybvig were honored for their research on banks and economic crises. The Nobel Prize Committee says the three improved the understanding of the role of banks as well as how to regulate financial markets. The Bank of England has expanded its emergency support for the UK bond market. Its new steps to support gilts beyond this week are designed to broaden purchases. The BOE started the bond buying last month after market turmoil caused by the government's unfunded tax cuts. A mega yacht linked to one of Russia's richest men has docked in Hong Kong's harbor, and that's led the U.S. to warn the city that assisting sanctioned individuals could threaten its status as a financial hub. The yacht, called Nord, is tied to Alexei Mordashov, who was sanctioned by the EU, US, and UK following Russia's invasion of Ukraine. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
With the Federal Reserve's inflation mandate, inflation is much too high. Understanding where energy prices are going, where food prices are going, where commodity prices are going, it's very, very important to us, as it is to all Americans.
Neil Kashkari there, the Minneapolis Fed president. Much more from him, no doubt, through the week, alongside a host of other Fed speakers, including the Vice Chair Brainerd, coming up a little bit later. I want to check in on the price action for you. Equity futures slightly negative on the S&P 500, down 0.33%. Yields unchanged in the German bond market. Yields unchanged at about 220 on a 10-year. They're higher in Italy by 4 basis points to 475. Keep talking about the spread between Germany and Italy. We have gapped out in a major way, Lisa. In fact, we're trading higher above all of the QE years. 254 is the spread right now. So the yield, the 10-year yield, if you look at the QE years of, say, 15, 16, 17, 18, 19, 20, 21, we were never trading up here. You've got to go all the way back to about 2013 to see the Italian yield. We've seen the spread this wide in the last couple of years. Saw that in the pandemic. But for the actual yield in Italy, you've got to go back a number of years.
Which really comes in the heels of a number of discussions from ECB officials, including Klaas Knot earlier today, where he was saying he sees 2 consecutive meetings of significant rate moves. How much is the requirement very high for them to come out and some more details about what they plan to do to support peripheral bond yields at a time when they're really seeing yields that we have not seen, as you said, in a very long time?
Just remember Euro crisis, at the peak of that, I think we had a 7 handle on Italian 10-year debt.
Okay, sure. But
when we had the whatever it takes speech in the summer of 2012, 6 handle. So I just want to state that, you know, we're not at those kind of levels on a 10-year.
how much do you look at these comparisons as valid, considering how much debt has been issued since then at incredibly low yields that might need to get refinanced, right? I mean, this idea that it is different to have a 6 or 7% yield today than, say, in 2010.
I do wonder whether you've got some unique issues, though, in Europe, whereby some of these governments have done a lot of hard work over the last 10 years, particularly around the maturity profile of some of the debt. They've all locked in low interest rates, pushed them out. I hear this a lot in the credit market, too. When do you actually see the stress? When does the maturity wall kick in? And what you hear back from many people is not in the next 12 months.
And if that's the case, then perhaps central banks can afford to go much higher before it becomes a problem, because there is this sort of built-in resiliency. It's a good point with respect to government debt, at least in Europe.
But when you're focused on Europe, just the low growth profile of the years to come, you do wonder how viable some of those models are with 5% interest rates on its debt as that starts to get priced in a little bit more. Especially as you have to plug the gap from some of the energy crisis that a lot of these nations are facing, and you see some of the fiscal spending that's come up as a result. Bob Yorga can talk to us about energy. Joins us now, Energy Futures Senior Strategist and Executive Director at Mizuho. Bob, you said you're not a big believer in the OPEC plus 2 million barrel production cut. What do you mean by that?
Well, I think they will see only about 1 to 1.2 million barrels of cuts that are actually made in this OPEC production cut deal. You'll see Saudi Arabia cut. They're good for their word. United Arab Emirates, same thing. But there's a lot of folks in a lot of countries in OPEC that are underproducing for size. They're not going to cut production further. Russia's basically around 1.3 below the existing quota going into the OPEC meeting. Nigeria was about 800,000 barrels below. Angola was 400,000 barrels below. They're not going to cut any further. And a lot of the other participating countries are happy just to stay where they were. They're not going to go out and pull back on production today. They're just going to do their best to stay where they are. They're struggling to be where they are. So I would expect to see Saudis cut. I would expect to see UAE cut for about 1.1 million barrels.
Given the lack of spare capacity, Bob, why are prices not higher?
Demand is really the issue here. I think that's another one that the OPEC folks missed a little bit. The problem is not supply. The problem is demand. We are here. The dollar is higher for starters. That is a reverse correlation to the barrel, to crude oil. Higher the dollar, the less dollar it takes to buy a barrel of crude oil. The China situation is very negative for OPEC. That's a big piece of the demand puzzle that's been taken off the table. So until that comes back, we're not going to return to $130 like we were in March. But you also have the global economy teetering on the brink of a global recession here. That's a demand event. Right. Cutting barrels is not going to make a big difference there.
Bob, on October 16th, the People's Party Congress, National Congress over in China is going to kick off. And a lot of people are looking at this as a threshold moment after which perhaps the zero COVID policy could be lifted in some capacity. What would happen if you did see a softening, especially as we've heard pushback from other officials recently about how unsustainable this policy really is?
If you come out and you see that red headline on the Bloomberg terminal, that's going to definitely see the price go up a little bit here. We probably would trade towards, if China's on the way back, and if that's a big move in the right direction, we probably will see the market trade towards $100. But I don't see it returning to $130 where it was at the beginning of the Ukraine crisis. So yes, that would be, that's a big piece. That would be a big demand construction event. And it would be very positive for the market. But above and beyond that, with the Fed still likely to increase the rate situation by 75 basis points next meeting, 50 the one after that. I mean, they're purposely pulling back on the global economy. So it's going to leave a mark.
Hey, Bob. Thank you, sir. As always, Bob Yorker there of Mizuho Americas. Bank of America's Mike Gapin on Friday after the payrolls report. Lisa, no pivot for you. No pivot for you. The message from the team.
No pivot for you, no pivot for you. It's sort of the reverse Oprah Winfrey. But this was basically the message from every single central bank and Wall Street bank out there, basically saying this is not going to give the Fed any ability to move away from some of the rate hiking plans. And that has been basically the theme, right? And so at what point does it really go back to the conversation that we were having at the beginning of the hour, which is how are they going to go much further than perhaps they need to in order to rein in an economy with policy that has a lag effect that isn't necessarily going to really show the consequences for a number of months, if not longer?
One question I've asked is whether the labour market data overstates the strength of the economy elsewhere. And most people agree with that. The labour market data looks really robust. You can find pockets of weakness all over the place.
That's the reason why I wonder if earnings are going to be the main event of this week. If we see the earnings move much more quickly than we had previously expected, we see this in a number of different sectors. We've seen that from forward revisions downward for earnings guidance. There already have been revisions downward on Wall Street, but have they been enough? And if we start to see them come in more rapidly, how does that sort of feed into this narrative, especially when there is the FX component, especially when there is this inability to pass along the costs that you had seen in previous months and quarters.
David Costin talked about the dollar story, right, over at Goldman.
30% of all U.S. corporate earnings derived from international sales.
Hey, it's a problem, isn't it?
And you're seeing this with multinational companies across the board. The RBC put out estimates of how much sales are expected to decline because of just of these things, particularly in the manufacturing sector, the industrial sectors.
Futures on the S&P 500 down by around about 1/3%. Live from New York City this morning. Good morning to you all. David Riley's coming up from Blue Bay. Looking forward to that conversation. We're going to have a little chat about this European bond market with Italian yields climbing just a little bit higher. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
The Fed has kind of entrenched themselves and kind of like, no matter what happens, we're going to do it.
They're raising rates extremely quickly in order to fight inflation.
Yes, monetary policy operates with a lag, so we're waiting on those lags.
We do expect the market to remain volatile. You know, these rallies that we're seeing, we continue to expect them to fade.
We are walking a knife's edge difference between a soft and a hard landing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
I think we start every week saying big week coming up. Big week coming up. There's a big week coming up. Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. TK, I believe, is going to come back with us in a couple of days' time. Futures, we're down about 1/3 of 1% on the S&P. Bramo, there's a big week coming up.
This one actually is. I mean, really, like this one actually is a very big week because we've got CPI and we also have earnings. We also have University of Michigan sentiment. That is just for you, John. But we also have the IMF and all of these meetings, these confluence of events sort of capped off by the end of the week, this expectation of what's going to happen with the Bank of England. They did push it out, but still there is this feeling, this drumbeat into something monumental heading into year end.
Mike Wilson of Morgan Stanley had this to say to kick off the week. Here's the quote from him. Last week packed in a year's worth of volatility, both up and down, as the market battle between deteriorating fundamentals and supporting technicals continues. Ultimately, he says, fundamentals prevail. And Lisa, it could take longer than we would like, is the conclusion.
And the other conclusion is this has been really building on what he's been talking about all year. And now other members of the Wall Street analytics community are really getting on board. They're basically saying the same thing, and you're starting to see on the ground evidence that they are correct, with FedEx coming out on Friday yet again with some expectation of deteriorating demand. You're seeing this across the board in both the tech sectors as well as the retail. How much and how important is Apple going to be later this month when we start to understand how much this is not just a semiconductor story, but a demand for a small electronic device story? And this really will be huge for a company that has such a big proportion of the overall index.
Lowered the bar for them, didn't we? A couple of weeks ago when we came out with our report and said the demand for the iPhone was faltering. How many times have we played that game with Apple? Then Apple come out on earnings day and kind of knock it out of the park.
So you think that basically demand isn't falling off?
I'm not saying that.
But,
I'm just saying we've been surprised in the past when it comes to that particular name.
So this is one of the big questions that I have, because what we've seen is disappointing earnings or earnings guidance has been met with incredible punishment in the stock market, right? We've seen incredible moves in these names. Are people building in the expectation that they will surprise to the upside? What happens if you get a name that accounts for such a significant portion of the overall index plunge massively just in one day?
The worry I have is not around Apple, it's around the FedExes of this world. And the reason I would worry about that is just how quickly the cycle seems to be moving lower based on their communication. They were surprised on it. They seem repeatedly surprised by it. And I'm just wondering if that's going to be the theme for this. And it started with Chris Harvey of Wells Fargo for me. When Chris came out a number of months ago and said, wait, pause, that weakness you expect first half of 23. And then when we started to get this news from FedEx and other companies too, he moved that forward pretty quickly, pretty aggressively.
And so did a lot of other banks. What does the Fed do with that, though? Especially if you don't necessarily see a deceleration in core inflation, which you're not necessarily going to see because, again, it is a lagging indicator in terms of how quickly some of these base effects can really take effect, particularly with the rental unit component of this particular CPI reading.
Rock and a hard place. How isn't a recession the base case on Wall Street yet? Why are we still seeing notes that say things like 40% chance? And then you have this scenario analysis around the equity market, and it says at the bottom, like, this is our base case, but if we go into a recession, why is that not the base case?
It's a good question. And what does it mean in terms of how deep that recession is? Remember, we were discussing that, and somehow that's not part of the discussion anymore.
Short and shallow.
Yeah, exactly. The other aspect of this that sort of is the other side of just the question that you're asking is, you're seeing sentiment, at least in the surveys, deteriorate dramatically. And yet, when you look at positioning, people are still bullish overwhelmingly for equities. Or, you know, it really has not cohered in the same kind of way as you would expect, given just how bearish sentiment has gotten.
Futures right now down 10 points on the S&P. We're down about 0.25%. I'll whip through the price action for you. In the bond market, remember the Treasury market closed for Columbus Day. Looking at the German bond market, basically unchanged on a 10-year at 220, not unchanged in Italy. We'll pick up on that in just a moment. Euro dollar, Lisa, 96 handle on euro dollar, 96.94, negative 0.5%.
And is this an energy story? Is this a question about what they have to do with respect to the Italian yields in terms of coming in with some sort of easing? A lot of questions on a day where you're getting sort of thin trading, at least with the bond market being closed in the U.S. Today, we are looking at a host of particularly Fed speak, because when there isn't other events, there is always Fed speak, including Chicago Fed President Charlie Evans at 9 a.m. and Vice Chair Lael Brainard at 1 p.m. I'm particularly interested to hear what Lael Brainard has to say about some of the international concerns. When does the dollar become the U.S. problem? I think that's going to be a theme this week, especially into earnings. There's also going to be some discussions out of the ECB. We heard from Klaus Knott earlier today. We do hear from Chief Economist Philip Lane speaking at 9 a.m. on the online ECB conference on monetary policy. And John, you were asking, when do we get a recession as a base case on Wall Street for the U.S.? When does recession become a base case for the ECB, considering that it already is the base case for houses across Europe and across the U.S., right? I mean, who does not think there is going to be a recession in Europe right now?
I think it's bizarre. We got to this point where central bank forecasts are just aspirational. Seems to be what they want the data to be. And I guess they feel like that if the data isn't where they think it's going to be in 2 years' time, that it's somehow a credibility failure, that they need to do better than they're doing. I think the other worry is the self-fulfilling aspect of it. The policymakers believe they start forecasting something, they can shape the events that they anticipate. And I understand that, but I think at this point, the Bank of England's done it, held their hands up and said, this is where I think this is going. Base case is a recession. You'd expect the ECB to follow.
And we could talk more about this, and maybe it actually adds to credibility when they say it. And the IMF meetings, the annual meetings are kicking off, the IMF and World Bank in Washington, D.C. We hear from David Malpass and Kristalina Georgieva later this morning and throughout the week. John.
David Riley joins us now, Chief Investment Strategist at Blue Bay Asset Management. David, I've got a German-Italian 10-year spread at about 255 on my screen. David, when does that get problematic for this ECB?
I think it gets problematic for the ECB in terms of potentially even, triggering speculation around the TPI. Once we get to sort of spreads closer to sort of 300, and all-in yields then would be closer to sort of 5.5% on the 10-year BTP, and I think we're a little way away from that. But a kind of key is going to be the Italian budget at the end of this week, and hopefully they've taken a bit of a lesson from the experience of the UK government, where I think there's been a huge kind of policy credibility crisis in the UK, and that ultimately was the trigger for the sell-off in gilts, and obviously that then spilled over into other markets and created problems with UK pension funds and LDI investment. But I think the key takeaway, hopefully, that policymakers in Rome have taken is, this is an environment where the bond market vigilantes are back, and you kind of go down a fiscal easing route or unsustainable fiscal path at your peril.
Well, David, the old playbook of the last 10 years used to be get to these levels, buy them. Buy them because the ECB's got to step in and stop them from going any higher. Have we put that playbook in the trash can? Are we doing something else now?
Well, I think in terms of the so-called Eurozone periphery, then, I think the ECB, does really kind of take out the kind of extreme sort of left tail. I think they have indicated, obviously with TPI, that, they will and are able to intervene to prevent that kind of sort of extreme event and sort of some kind of self-fulfilling, liquidity crisis that drives up spreads to unsustainable levels. But I think we are in a regime change more generally, where we've gone from a situation where the search for yield, zero rates, QE infinity, meant that governments could, spend as they chose to spend, could borrow without any considerations for the bond market. And, I think the UK experience is a wake-up call that we are in a changed regime. We've kind of gone back to a situation where macro policy does matter, how coherent it is, and whether you've got sustainable public finances. How are you going to pay for this over the longer run?
To that point, David, what will the euro response be? Will it weaken versus the dollar or strengthen if the ECB comes out with some sort of cohesive plan to help control some of the rise in peripheral spreads?
Well, I actually think that, the euro will weaken on that kind of scenario, because potentially that also means that the ECB is going to have to kind of step back, if you like, in terms of either the pace or the end point for its rate hikes, and also around this whole debate around quantitative tightening. I suspect the ECB does have an eye to what's going on in terms of the periphery, and so I'd be surprised if they choose to go down the route of actual quantitative tightening, so actually actively running down their balance sheet. At the moment, they are reinvesting bonds that they hold, and that actually is providing them with some flexibility as well, where they can actually kind of lean against the market while continuing, in terms of peripheral spreads, while continuing to hike rates.
David, do you think QT continues at the Federal Reserve through next year?
Yeah, that's a good question. I mean, I think, the Fed itself, I think the constraint in terms of QT is what actually happens at the sort of in money short end funds and money markets in the US, and what is the sort of level of reserves that is sufficiently ample for US banks, and frankly the Fed doesn't know where that is. I don't know where that is, so I wouldn't be surprised if the level of sort of reserves is higher than the Fed currently thinks, and so that does actually mean that the Fed comes to a sort of earlier end to QT. I don't think they will bring QT to an end early because of concerns around sort of monetary policy tightening more generally.
Got it. David, thank you, sir. David Riley there of Blue Bay Asset Management. Futures slightly negative. We're down 0.25%. Coming up in the next hour, Vishy Tripator of Morgan Stanley. Looking forward to that conversation. Live from New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening more attacks against Ukrainian infrastructure after Russian missiles struck Kyiv and other cities today. The missile barrage was the most intense since the early days of the war. The attacks came after Putin blamed Ukraine for an explosion on a key bridge link between the Russian mainland and Crimea. Ukraine hasn't claimed responsibility, but within hours it commemorated that blast with a new postage stamp. In the UK, Chancellor of the Exchequer Kwasi Kwarteng is taking steps to calm financial markets following a turbulent period. Kwarteng will announce his medium-term fiscal strategy and economic forecasts on October 31st. That's more than 3 weeks before he had originally planned. In Germany, an advisory group is urging the government to subsidize as much as 80% of natural gas consumption for households and companies early next year. It would be part of a $194 billion aid package. The government will review the recommendations and issue a decision in the coming weeks. Shares of Rivian are falling. The electric vehicle maker says it will recall about 13,000 EVs delivered to customers after discovering a minor structural defect. That's nearly all the vehicles Rivian has delivered. And former Federal Reserve Chair Ben Bernanke is one of 3 people to share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond, and Philip Dybvig were honored for their research on banks and economic crises. The 3 will share an $885,000 award. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are in Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
I've
been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full-service shadow banking with nobody in charge.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This October, delegates will meet for the 20th National Congress of the Chinese Communist Party. As questions mount about China's economy, COVID-0 policy, and foreign relations, President Xi Jinping is looking to secure an historic third term. Keep it tuned to Bloomberg for the up-to-the-minute coverage and expert analysis you need. Coverage begins October 16th with special Sunday programming on Bloomberg, your global business authority.
I think we are headed for a collision of some kind or other, and we've just got to manage that collision carefully. And I think the sooner we start managing for some slowdown, the better we're going to do.
Larry Summers there, the former Treasury Secretary on Wall Street Week with David Weston over the weekend. Live from New York City this morning. Good morning for our audience worldwide. Here's the Monday morning price action. Futures down by around about 0.2%. The US bond market closed for a national holiday, Columbus Day. Yields up almost a basis point on a 10-year in Germany to 2.20. Euro dollar 96.99. We're negative 0.5% on euro dollar 96 handle. Lisa, just grinding lower, lower, weaker, weaker.
And is this because of what's going to happen with Italy and whether the ECB ends up moving away from some of their tightening plans in order to support certain yields in Italy, in Spain, in Portugal? Or is this because of the conflict between Ukraine and Russia, this escalation in that war with Russia attacking Kyiv overnight after the destruction of that bridge from Crimea to Russia?
Good news on gas storage out of Germany. Seen some high numbers out of them. It looks like they've got storage to where they want it to be going into this winter, and we've just got to sit here and hope that it's not a brutal winter, a freezing cold one. To repeat the act next year, though, without Nord Stream, is going to be tough.
You've made this point, and I think it is the most important point, that they have filled their storage tanks with Nord Stream gas, with natural gas from Russia. What happens when that gets taken away, especially at a time when other methods of energy, including the nuclear power plants in France, are not producing as much as people were hoping for?
Let's get to this conversation with Bloomberg's Anne-Marie Jourdain down in D.C. AMH, wonderful to catch up. The president warned about the potential for nuclear Armageddon in the last week. He did it, though, Anne-Marie, at a fundraiser, and he's taking some criticism for that. Can you walk me through just how this has played out down in Washington over the last few days?
He's taking criticism because critics will say that if you're going to make this very much huge remarks about the fact that we are potentially on the verge, on the edge of Armageddon when it comes to these massive nuclear powers, why are you doing it at the home of a Murdoch for a fundraiser for the midterms? But what we heard from Admiral Kirby over the weekend, who's the National Security Council spokesperson, he said nothing has changed. The president hasn't seen any new intel. He was just remarking on the state of play, but obviously his language was much more aggressive. Maybe the president was in front of a crowd using hyperbole. But the fact of the matter is, at the end of the day, the United States, since the very beginning, according to Jake Sullivan, has always said that Putin has brandished this weapon of tactical nuclear weapons, has said that he would do anything potentially to defend Russia, and they've always saw this as a concern, and that Admiral Kirby over the weekend said they're watching this incredibly closely, but nothing has changed the U.S. posture.
What has changed with respect to the U.S. willingness to provide other military gear to Ukraine, especially after some of the recent incursions, the latest being the attack on Kyiv?
Well, the one thing the Ukrainians really want is air defense missiles. And there was at the end of September, a recent interview Zelensky gave, and he said that those defense systems were coming from the United States. The Pentagon had talked about this a few months ago, but the delivery of that, the Ukrainians need to be trained on that. That takes not just weeks, but that takes months. And this is the systems they would need right now when you're seeing this barrage of missiles over Kiev. I spoke to the Ukrainian Foreign Ministry this morning. What they are seeking for from the international community is more of these types of air defense missile systems, as well as they want the international community to label Russia a terrorist state.
Anne-Marie, meanwhile, even as all of this happens, we heard over the weekend President Biden actually on Friday coming out and announcing the banning of certain sales of semiconductor and chip technology to China, which some people say is the biggest escalation between these two nations and what some are calling an economic war up to this date. Do you have a sense of why now and how much this has really changed the backdrop?
Well, officials will say that they want to cut China off now from being able to expand not just their chips, but this could, if it's implemented in a very harsh way, this could affect everything across China's economy. This could affect their military capabilities and technology. This can affect the manufacturing of electric vehicles, smartphones. The list goes on. And what officials will tell you is they want to be able to blunt China's power as an economic and military menace. This could potentially be seen on the heels of what we saw over the summer with China having these military drills after you saw Speaker Pelosi go to Taiwan. But obviously, this is a huge blow for, we should not just say, not just China, but also the semiconductor companies like NVIDIA, like ASML, that all their shipments and this technology goes over to China.
Do you want to squeeze in some baseball banter quickly?
No, not at all.
Well, let's just say, poor Lisa. Listen, Lisa, I think I was very classy. I think I was very classy on Twitter, giving my deepest apologies to you, Muhammad Al-Arian, Ivan the K. But there's only one team the New Yorkers could root for this postseason.
What are you doing?
Mets gonna Mets is what she said in the commercial break.
Yeah, Mets are gonna Mets. They're gonna get to this great point, and they have all this momentum behind them, and then they blow it. That's the Mets. That's Metsing.
I imagine down in DC.
What are you doing,
Could
John?
you come back in the next hour?
No, we're done.
We're done.
Thank you for that classy tweet.
Mets are gonna Mets. What was classy about that?
No, she sent out a tweet of her deepest thoughts, which basically was her rubbing in the face.
The deepest sympathies for Mets baseball fans. What happened? They were doing so well. Did you go out and buy Judge now?
Well, I mean, maybe, but it's really all about the ear and the potential for some possible.
Cheating.
Yeah, that's possible. I mean, I'm not saying cheating.
What would be on the ear?
Grease.
The pitcher?
Grease. That would then make it a firmer grip that allows him to make balls that make the Mets look terrible. But otherwise, they would be terrific.
This is worse than English football. So you start losing, you send the referee out to check someone's ears.
Sixth inning. So it was already used up. Honestly, my boys came home last night and
they were furious.
They were furious about the ear. Did you see his ear? Did you or did you not see his ear? I was like, they're the Mets. And did you not see his ear?
Would they feel better if you went and bought Aaron Judge now?
I'm sure they would feel a lot better, but I personally am not going to shell out. I'm not an expert in that.
No? Okay. Just checking in. All right. I'm pleased we discussed it, though, and I'm sorry for your loss.
Thanks, I appreciate that.
Brutal.
I'll rub it in for you when AC Milan starts losing.
We won against
I know.
Juventus over the weekend.
I know, but you're facing some challenges.
We are.
So we can bring them up. Yeah, exactly.
Personal and all over the place. As, you know, it's always the case, isn't it? AC Milan.
Yeah, well, I mean, see, AC Milan are Milaning.
Yes, futures unchanged on the S&P.
He's like, please save me.
Few points off the top of the league. We're not too bad now. It's not what we were 20 years ago, which is...
Well, the Mets almost made it.
Which was a beautiful thing. We were so good 20 years ago.
1986. Mets were pretty good, too.
Great in the 80s, the early 90s, 2000s. And 2010s just went really wrong. I don't know what happened.
Sorry to hear that.
From New York.
Sorry for your loss.
This is Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Live from New York City this morning. Good morning to you. Equity market shaping up as follows this Monday morning. Equity futures on the S&P 500 slightly negative. We're down 0.1%. Down a little more than 0.1% on the Nasdaq. 3-day losing streak coming into Monday. In the bond market, the Treasury market closed. We'll look at the German bond market for you. 2s, 10s, and 30s. A 10-year at 2.19. About 12 months ago, I think the 10-year was in negative territory. So that is a monster turnaround for the German 10-year. Compare it to Italy. The spread 2.53 at the wides of the year, and that's a problem for this euro. Euro dollar is negative. Euro dollar negative going into the ECB meeting. Month end, I think October 27th for the ECB, looking potentially for a 75 basis point move, and a euro just struggling to find any traction, Lisa. Euro dollar 97, negative 0.4%.
I'm struggling to understand the response of the euro if there is some kind of move by the ECB that is hawkish, right? That should support the euro in the traditional book of central bank policy. Does that really apply anymore?
That's the dilemma of the last couple of months. You want to buy higher rates at the ECB, higher bond yields as they go into recession. That's the problem, isn't it?
And what do you do with the fact that they might be hampered with respect to particularly peripheral yields? I'm watching over in the single name space, some semiconductors, because we were just talking about the potential where you end up with some sort of restriction on American technology exported to China. You're seeing U.S. companies lose value. Anne-Marie was talking about this, and I find this interesting. It's not just the Chinese semiconductor companies that are going to struggle. It will be fewer exports by the likes of NVIDIA, where shares are down about 0.75%. AMD, that shares down in pre-market trading 1.3%, and Applied Materials with those shares down a little bit more than 1%. This just adds to a year that has been the worst year for semiconductors going back to 2008. And if the losses keep up at this pace, you could see the worst annual loss on record. We have seen a nearly 40% decline, or actually a 40% decline on these stocks, right? This is the Philadelphia Semiconductor Index. How much does this really speak to this broader pain, John, that we were talking about with the likes of Apple, with the likes of other electronic device companies? And how much are these really idiosyncratic stories affected by international policy that have been doubled down upon by President Biden, restricting exports to the world's second biggest economy?
Can I answer all of the above? Pretty much everything you said.
Well, I mean, but this is going to be a huge issue considering that these are major components of the overall indexes. And how much does this really feed into some of the downward revisions of some of the S&P targets, which we've heard even from some of the biggest bulls on Wall Street?
Seema Shah joins us now, Chief Global Strategist at Principal Asset Management. Seema, ringing the bell at the Nasdaq today. Buzzing for that, I'm sure. I always look up. Don't you always look up around the opening bell and people emphatically clap and wave their hands?
Even when it's down, which is always kind of interesting to me.
I always find that weird. If we're down today, will you scream and shout? And
I'm still going to clap.
You're still going to clap, even if we're down. Okay.
She's paid to
opportunities to buy. There you go.
Is that going to be your story whilst you're here? The opportunities to buy this?
On today, no. I have to say, I think there's worse to come for the market, unfortunately. You know, you talk about we talk all this time about the Fed, about inflation, about growth, and then you add in all these additional geopolitical pressures. It's very difficult to find anything to be positive about at the moment, and a lot of these things I don't think is fully priced into the market either. Earnings seasons, of course, is going to be really interesting. We are expecting to see weakness starting to really feed through now. A lot of the narrative about margin pressures, but also just generally starting to feel the pressure of consumers potentially pulling back from next year. So there's a lot, I think, to be concerned about for investors.
When you say it's not priced yet, out of everything you've just said, what isn't priced?
I still think that the recession is not priced, right? So I think the market is eventually, I mean, look, it keeps switching every few days, but I think generally speaking, the market is coming to terms with the idea that rates are going to go higher and they're going to stay there for longer as well. The bit that the market is still playing around with is this recession. You know, a lot of people still thinking that soft landing is possible. We think it's very unlikely. And with recession, unfortunately, does come earnings recession.
So which aspects of the market are not sufficiently priced? Because some people might look at retail, for example. They might look at some of the semiconductors, and they'll say recession's priced there. Where is it not? Or is it even the 40% decline on semiconductors that has not fully appreciated the depth of this downturn, not just whether there will be a technical recession?
So like you said, I think there are segments of the market which really have struggled, and semiconductors have been one of them. Unfortunately, the latest news probably suggests that there could be even further downward movement from there. So valuations at this kind of stage, they are instructive, but they're not going to tell the full story. So in the same way, in the last 5-10 years, we've known that valuations are very expensive, but it hasn't stopped markets from going up. Cheap valuations don't necessarily mean that markets are not going to go down further.
I was reading a piece of research over the weekend, which was talking about how if you look at some of the AAII sentiment, it looks really bearish. People say they're feeling terrible, things are going to go down. And then you look at their actual positioning, and they're still pretty invested in equities. They're still actually fairly bullish, at least in terms of their positioning. What's the trigger to wash that out?
So I think I'm not sure if you're going to see necessarily a washing out, because even from today, you know, we are expecting further declines. But the one question that keeps coming up, I've been traveling around the US in the last week, the one question keeps coming up is like, but when is this floor going to come? When can I start buying? Right, so that is the question that people are trying to figure out. When is the timing for them to increase their exposure? And I think at this stage, you know, if we look at historical bear market cycles, your average downfall is 27%. Now, if you're down 24% and you don't think this is going to be like the GFC, then we're more than halfway there. So if you're not already underweight, this is probably not the time to start reducing even further.
What do they ask you about Europe when you tour this country? How much do they hate that market right now?
So much, but I understand that, and actually I fully agree with that perspective for Europe. It is a very, very challenging time, and I think that what we're starting to see in the US is they are understanding that actually in Europe the situation is considerably worse. And put on top of that is there's so many things that we cannot predict. We're not meteorologists. We cannot predict what the weather's going to be. No one in the whole world probably can predict what's going on in Putin's head. So with those two incredible uncertainties, despite European valuations being so cheap, this is probably not the time to increase your exposure when you have those two things hanging over you.
You talked about the persistence of this, particularly around rates, that we could be living with this for the next 12 months or so. Then there's also a conversation taking place much more so in Europe now that we could be living with this for more than one winter, maybe two, perhaps even longer. When you start to think about the United States in that respect, 10 years ago we talked about the United States decoupling from the mess that was playing out in Europe. Is that still the case? Would you say that's still the case?
I think it is to some extent. I mean, one of the things that we are starting to feel is that in the US, there is this belief that there is a complete decoupling. But of course, that doesn't happen. You know, Europe, whatever European tensions there are, whatever the energy situation is, there will be leakage into the US. In Europe, you're already seeing this huge substitution from natural gas towards oil. And of course, there will be inevitable repercussions for the US as well. So I don't think it's a full decoupling. I think the US does come out better than Europe, but certainly not complete decoupling.
Okay, so bear with me, but everyone who I know is going to Europe for a vacation, including Tom Keene, who's over in Europe right now. And we're hearing about the negative effect from the strong dollar on U.S. companies, but that's because things are on sale effectively from, say, European industrials. So when is the currency differential a good thing for Europe the way it used to be, say, 5 years ago when the currency wars were reversed?
Well, I think you've already seen some of that play out this summer, which is why you haven't seen European GDP actually contract yet. If you look at Spain, Italy, all of the southern European countries have benefited significantly from the weak currency. And that is going to moderate a little bit some of the downturn that Europe's going to feel. But this is, I mean, from an investment perspective, for the US, it's one of the key reasons why we've been overweight mid-caps rather than large cap. The mid-cap exposure to domestic is significantly higher than what you see for large cap. And, you know, they've outperformed, and we expect them to continue to outperform.
One theme that we've heard from a lot of the investors who we speak with is it's starting to look attractive to go into longer dated bonds. How much conviction do you have around that kind of view, both in the US, but also in places like Europe?
So we have, for example, increased our exposure to long dated bonds fairly significantly in the last 2 months. A couple of reasons. One is that we are, as I said, expecting recession to hit next year. And in that environment, typically, you should see downward pressure on yields. But like you said, in Europe, there's the added pressure. What are central banks doing? They're raising rates, but they're also pushing down the long end. Or at least they're trying to push down the long end. at some point there's going to be some kind of success, or at least it's going to stop any further movement. So if you have to be anywhere in the yield curve, I would rather be on the long end than the short end for sure.
In the gilt market or treasuries?
I don't think you want to be in the UK.
I asked the question because you're based in London. I just wondered whether you've been buying gilts in the last couple of weeks.
We did not foresee what was going to happen to the gilt market, like anyone else, I think. Just generally speaking, the UK, we have serious concerns about. The fiscal story is not going to improve, I think, as much as they can walk back. There are certain segments of that political story, the fiscal story, that they're going to stick to. So if you're looking at it over a longer-term horizon, the UK has a worse inflation problem. It's got a worse growth problem. So if I had to pick one over the other, I would pick the US.
Halloween budget, what do you want from that?
As an economist, I want them to unwind everything.
Yeah.
Unwind everything. Just go back to having some serious fiscal policy where they're trying to actually balance the budget in the same way that really in the UK, unlike many other countries, fiscal balancing is a hallmark of fiscal policy for the last 2 decades. So for them to walk away from it at this time is a very difficult time. In 2 or 3 years' time, who knows, trickle-down economics could work.
Do you think that everyone in the UK right now, you ask them about what's going on with the gilt market and they just sort of sigh and look at you like, please, can I just disappear right now?
Don't buy the gilt market.
Yeah. That's sort of...
If someone did buy the gilt market and made a tremendous amount of money, can I just say that when the Bank of England stepped in and yields dropped by, 100 basis points at one point in that day?
Which is the reason why, I mean, to Seema's point, the reason why the long end perhaps is getting some credence or some conviction on people, because they do believe eventually central banks will step in, at least for that, because of some of the structural issues that require some
Even
sort
without
of,
them stepping in,
change.
at some point you'd have to believe bonds start behaving like bonds, going into an economic downturn.
People have gotten wrong what that point is, though, again and again. And we have seen people change their expectations for how high yields could go. And at this point, I think there's a feeling of being shaken a bit about what is the base at this point after a world of zero rates for so long.
Massively. Zero confidence in a high volatility world.
Zero confidence.
A complete lack of conviction. Seema, thank you. Enjoy ringing the bell. You press a button, right?
It's a button. I wish it was
so disappointing.
There's nothing cool about that, is there? Just sort of... I don't
technology.
Tower.
Seema Shah,
so much better.
Principal Asset Management, should go in with your own bell and just, shake things up. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russian missiles hit Kyiv and other Ukrainian cities today in the most intense barrage since the early days of the invasion. And Vladimir Putin threatened further attacks, warning that the action would be harsh. That came after Putin blamed Ukraine for an explosion that damaged a key road and rail bridge connecting Crimea with Russia. Ukraine hasn't acknowledged it was responsible. Former Federal Reserve Chair Ben Bernanke and 2 U.S.-based colleagues share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond, and Philip Dybvig were honored for their research on banks and economic crises. The Nobel Prize Committee says the 3 improve the understanding of the role of banks as well as how to regulate financial markets. The Bank of England has expanded its emergency support for the UK bond market. Its new steps to support gilts beyond this week are designed to broaden purchases. The BOE started bond buying last month after market turmoil caused by the government's unfunded tax cuts. Semiconductor stocks today across the globe fell. New U.S. limits on China's access to American technology added to a disappointing start to the earnings season. China says the measures are unfair and also will hurt U.S. companies. And the tight labor market is pushing more businesses to hire job seekers who have served time in prison. The Wall Street Journal points to recent data from the Society for Human Resource Management Foundation that shows 46% of professionals said they recruited people with criminal records more often than they did a year ago. About 600,000 people are released from federal and state prisons every year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leni Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
Very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
Seeing is that the dollar is causing a lot of problems globally in emerging markets and elsewhere. So it was a case to be made that if you think that you're getting benefits from the strong dollar, that this reverse currency war is kind of playing your way, that you're probably fooling yourself.
Steve Englander there, the global head of G10 FX research over at Standard Chartered. Live from New York City this morning. Good morning. Lisa Brammitz, Jonathan Ferro, TK back with us in a couple of days. Let's get you some price action briefly on the S&P 500. Slightly negative. We're down 0.2%. Yields up almost a basis point in Germany, 220 on a German 10-year. Euro dollar breaking down here, 96.94. We're down 0.5%. Lisa, that's a weaker euro.
And how much is this because of what's happening with the acceleration in the conflict between Ukraine and Russia? And how much is this just because it seems like the ECB is even more in between a rock and a hard place than the Federal Reserve with respect to not being able to tighten as much because of concerns about peripheral yields? And we see that with yields rising today pretty significantly.
They meet again in about 2 weeks' time. Let's stay on this story and head over to Bloomberg's Maria Tadeo, standing by with a special guest. Hey, Maria.
Jess, we are joined, of course, by the Dutch Deputy Prime Minister and Finance Minister, Sigrid Kaag. And, we talk about energy and the European economy every day on the show. But today we have to talk about Ukraine, because what we saw this morning is essentially a country that was blitzkrieged almost by Russia. When you see that, not just as a politician, but a European too, how does that make you feel? How do you respond to that?
Well, I think on a human level, it is horrific. The indiscriminate shelling of innocent civilians, cities, constitute real violations, tangible violations of international law, humanitarian law, and I've heard the Commission already speak of war crimes. But our heart goes out to the people of Ukraine, and it's also very clear that their will not be broken. nor that of NATO or the European Union. We need to stand firm with Ukraine, particularly and even more so in the face of such cruelty and such war violations.
And when you say we need to stand firm with Ukraine, does it mean sanctions stay put? Maybe they go in crescendo? That support financially will also materialize, not just on weapons, but the cash they say they need?
Well, on all levels, politically, militarily, financially, the humanitarian support, there is one front. It's a European front and, of course, our NATO allies to make sure that the Ukrainian government and the Ukrainian people get what they need in order to withstand these atrocities.
And of course, as we reported today, what they want is air defense systems, and Russia also branded us a terrorist state. But going into the impact that this has to in Europe, because we can feel it pretty much every day in the cost of living, food crisis, inflation, energy bills. When you look at this blackmail in the hands of Russia, how do you respond to this economically? How can you alleviate some of the pressures if you can?
Well, we do need to alleviate. We do need to also invest, of course, and support our own citizens, particularly because it can't be that the outcome of this war will be that our population is suffering, that they feel there might be a loss of support for this righteous effort to support peace and security and international law standing by the people of Ukraine. So it can't be. So we need to make money available. We need to have the right support packages, as we have been doing, each country in their own way, but often in a coordinated manner, because our own populations also need to be able to get through winter, and the response to blackmail can never be that we give in.
And you mentioned the coordination, and that takes me perfectly to my next question. There has been, over the past week, a lot of debate in Europe about national measures are great, but not everyone has the same fiscal capacity. It's not a secret that Germany created a lot of tension with this 200 billion euro package, and there has been now calls that perhaps this merits new tools or a form of joint response. When you look at it from the Dutch perspective, how do you look at this?
Well, in all fairness, we've also recently announced a very generous additional package in support of households and small to medium-term enterprises. And it's a temporary set of interventions, as is desirable by, for instance, the ECB or the IMF. If you support, if you help, do it tangible, do it targeted, and make it time-bound. But I also acknowledge that, of course, the pockets of every country are different. The fiscal space for every country is different. But many countries have undertaken similar measures, sometimes earlier, and you can't compare them one-on-one. What we've been trying to do as ministers of finance, and of course also in the informal meeting in Prague, the prime ministers, to see what we can do together, where the means can be found, and how we can take a longer-term view, because this crisis will be with us for quite some time.
And the market, however, they're looking at potentially something that may not be a recovery fund, but may see, well, joint action or actions backed by the European Union's AAA rating. Is that something that you would contemplate?
Well, from the Netherlands so far, we've said there's a lot of money available in the different funds that we've created for other crises. I mean, and the Recovery Fund, Repower EU is a recent one that also accelerates the energy transition. There are billions and billions of funds available that have yet to be allocated. Let's look at that first, and let's see what our joint course of action will be. And at the same time, we always call for national government action where that's feasible. At the same time, we need to look towards debt sustainability, not just of our own country, but of the Eurozone as a whole.
And that takes me to a final question that will be another point of debate here in the Euro area, which is debt to GDP. The idea was 60%, deficit below 3%. By now, it's almost clear that some countries are not going to get to those levels in a long time. And in a moment in time where you have to also invest in your own security, is that even doable? Are these targets, I mean, should we even take them seriously anymore?
Well, the 3 to 60% are matters that are vested in the treaty. Let's focus, from my perspective, we've said that as the Netherlands and jointly with Spain, let's see what are credible debt reduction pathways that can be worked out at a national level, and at the same time look towards the reforms that are required that have been lagging, and the investments that have often not taken place. In moments of crisis, we need to keep our eye on the ball, think long term, but at the same time we need to make sure that when you agree to a debt reduction pathway tailored to your national economic and fiscal space, we also need to make sure that there's effective oversight, that if one doesn't align with the agreement set for oneself, that there are other measures. So it's a balancing act, and I'm looking forward to the real conversation once the Commission publishes its proposals end of this month.
And this will be a real balancing act, especially as we see some of the yields jump across Europe. Minister, thank you so much for your time. Always appreciate it, and good to see you on Bloomberg TV. Jonathan?
Hey, Maria, thank you. Wonderful work, as always. Maria Tadeo there on the latest. I promised you that number a little bit earlier on German gas storage, the level at 94.07% as of October 10th, according to the regulator. It's always interesting to listen to them talk about the need for oversight on economic matters when it comes to the budget. And then when it comes to the absurd foreign policy mistakes made by countries like Germany that many other European nations have to pay for as well, this goes missing. I just think that it sounds a little bit hypocritical sometimes compared to where we were 10 years ago when the mistakes were made on the periphery and other mistakes have been made in the core. We seem to be having a very different conversation.
That's why I wonder, it'll be interesting whether this time around, when there is some desire for lower yields in Italy, when there is some desire to perhaps loosen up the budget, whether there'll be a bit more openness on the part of the German members of the European project, just exactly to that point.
Do you think the Spaniards, the Spanish might have something to say about whether you should outsource economic security to China, energy security to Russia, defense to the United States?
I'm sure that they will have something to say, and you're already seeing the pushback with respect to German popularity within the bloc.
From New York, this is Bloomberg.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
The Fed is on a one-way freight train, and they're moving very quickly.
We're going to see growth slowing, and we're going to hear from a pretty tone-deaf Fed that they're going to continue to raise rates.
We haven't seen the significant tightening yet.
The Fed is lagged, right? Because they have to wait for the body of evidence of the data to come in.
End of the year, though, we think that that's when the Fed is going to stop and pause and sort of look around and assess this situation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Coming up this week, CPI, some bank earnings, and some out-of-date IMF forecasts. Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance with Lisa Abramowitz. I'm Jonathan Farrow. TK will be covering those out-of-date IMF forecasts a little bit later this week. That's not the promo. Tom will give you the promo in a few days' time. I'm looking at equities down about 0.2% on the S&P. I'm looking at a gilt market. Lisa breaking down. Yields up and away.
And it goes back to what we were talking about earlier in the show, this idea that they did move forward, the UK Treasury and the Bank of England, their plans to really extend some of the support for the market and then to release some of those projections early. Will that help? And the fact that the market is pushing back and suggesting maybe not is really a problem, especially for these pension plans.
I do like the sequencing now. It's better. This is what we all wanted, so I can't complain too much this morning. We wanted the budget and the forecast to come before the Bank of England, so the Bank of England could fold that into their own forecasts and then calibrate policy effectively, appropriately. I think we're all just waiting to see what October 31st brings now. They're the new dates if you're just tuning in. So on Halloween, we get a budget from the UK together with the Office of the Budget Responsibility delivering their forecast. Then a couple of days later, Lisa, we're here from the BOE.
You asked Marcus Ashworth, what does the market want? Because if this does not get delivered in the way that they want, that the markets will not respond well. And what they want is basically to push out some of the expected support that the Trust Administration has said, even as the administration comes out and says that they are going to increase some of the support, for example, with inflation-adjusted pension payments and things of these natures. How are they going to pay for it, given that the pushback has really come from the bond vigilantes?
Clearly at this point, without the support of the central banks as they continue to raise interest rates, I think Priya Misra of TD then that said the Fed will be continued to be tone-deaf and keep on hiking. We want fiscal discipline. What's funny about the situation in the UK, they've been widely criticised by pretty much everyone under the sun about the policies that this Chancellor came out with in the last couple of weeks. But as Marcus Ashworth of Bloomberg Opinion pointed out, in 12 months' time, when many of these economies are in recession, some of these policies will be the policies that a lot of people are pushing for.
And this really raises an interesting point about how much fiscal response can actually offset the duration of the downturn that's to come. Some people say, well, in 12 months' time, there will be more appetite for it. Other people saying yields will still be high. You will still have high inflation. Perhaps not. And this really goes to the heart of the reason why some people are saying this recession, this downturn might not end that quickly. This is the Morgan Stanley view of things.
Sure.
Because of this sort of lack of a fiscal response that we are expecting based on where yields are.
A lack of any response, typically, and we talked about this last week, you would have some form of counter-cyclical circuit breaker. Can't come from fiscal right now because of what Guy Johnson called febrile markets. It can't come from monetary policy because the objective is to tighten financial conditions and get inflation lower. Where does it come from?
And some people are saying maybe a productivity shock, but a lot of people don't really have a good answer to this, which is the reason why you're hearing more of an L-shaped recovery. We heard that from Ellen Zentner last week, and that raises this issue of how much people can get confidence over longer-term returns in equities, the reason why bonds are looking better to people.
Yields up in the UK on a 10-year by 15 or 16 basis points, on a 30-year right now up by 22. Let's whip through the price action for you. Futures are negative 0.2% on the S&P. In the German bond market, yields higher by a basis point or so. Pretty muted price action over there. The Treasury market, of course, closed today stateside. Crude down 0.5%, $92 after a monster rally through last week on WTI. And euro dollar 96.96, a 96 handle on the euro, Lisa, with negative 0.5%.
And that pain, where is it coming from today? Is it because of the acceleration or the exacerbation of the conflict between Ukraine and Russia? Is it because of what's happening in Italy? Is it because of the prospects of possibly a difficult winter I mean, what's on the margins going to cause this to shift one way or another?
Toxic brew.
Nodes of disapproval.
Toxic brew.
Nodes of discomfort.
Vishy Tirupatur joins us now, the head of US fixed income research over at Morgan Stanley. Vishy, financial conditions tightening. We're looking at companies that, in some cases, are struggling to get the finance they might like across the economy. Vishy, we've talked a lot about monetary policy's role in all of this. Do you think something else is going on?
I absolutely think, clearly it is right for us to talk about the continued policy tightening from the monetary policy perspective. I think it's also important to see what else is happening. At the same time as monetary policy is tightening, regulatory policy, particularly on banks by the Fed on the large cap US banks, is also tightening. What we took away from the CCAR stress tests is effectively a capital call on some of the large banks. That effectively translates into very substantial pressure on the risk-weighted assets that banks hold. And dealing with risk-weighted assets means that the banks will have to either do less of what they're doing or choose to lend less, to focus on some sectors, de-emphasize some other sectors, do something else, all of which translates into lower credit formation and greater illiquidity and less of ability of the banks to step in when they need to disintermediate during market dislocations. That's my biggest worry.
How much is this offset by all of the private investors, by all of the big firms out there that are not banks that have really emerged as primary lenders?
It is a little bit of an offset, but not a sufficient offset. A large number of these private firms, non-banking lending, ultimately does require look to their exit in the form of securitizations or alternatives to that. And a lot of those vehicles still require banks to provide the senior leverage, by buying the senior tranches of these types of securitization products. And that's, again, a major challenge. And you've seen that, we're seeing that in every market that relies on bank participation to provide senior leverage, you're seeing spreads stay wide and stay sticky.
Vishy, there's another dimension to this conversation. Given what you said about banks' inability to step in, who's holding the bag when things get really bad? Who has this exposure? Can we talk about that just a little bit more? Because Lisa and I have gone over this over the last few months, through much of this year. We've just unwound about 10 years, a decade's worth of stimulus in some cases, zero rates, negative rates, it's all gone. Trillions of worth of QE, it's all gone. The bond market bubble, it's blown up. Vishy, I'm still trying to work out who's holding the bag. Where's the leverage? Where's it sitting?
It's a hard question to answer, John. I think we found out from the 2 weeks ago with the response in the gilt market is that this type of dislocation could very quickly translate into forcing a policy U-turn, both from the fiscal side and to some extent on the part of the on the monetary policy side, central bank intervention. All of that points to potential for an accident is certainly high.
Vishy, is this bullish or bearish for credit? I mean, on one hand, it's bearish because it could lead to a widening of spreads, a lack of lending, the potential for more insolvencies. On the other hand, it signals a policy response that right now seems like it's not on the table.
It's not on the table. I think we are on the margin. We are bearish credit in the sense that spreads, we are looking for credit premia to get wider. But I want to be distinguished between the spreads and yields. The front end of the investment grade curve certainly showing attractive enough yields that, in a world of broadly bearish outlook for risk assets across the board, relative shelter is on the front end of the investment grade curve.
Vishy, wonderful to hear from you, sir. Just a final one from me. 75 nailed on for you and the team at the Fed's next meeting. Does CPI matter this week?
Probably not. In my opinion, if our expectations on CPI hold, 75 is on.
Vishy Tirupatur of Morgan Stanley. Vishy, thank you, mate. As always, good to catch up, buddy. 75 nailed on seems to be the take from most people we speak to at the moment, Lisa, for the Fed's next move.
There is, though, dissent around the margins where there is a shift in tone away from the Fed needs to keep going incredibly aggressively, they're way behind the curve, an increasing number of people who kind of agree with Tom Porcelli and believe this feeling that perhaps things are moving much faster, much more quickly than the hard data is suggesting. And the Fed might be over-tightening. And this is new, and I'm hearing this from more people out there, that could be a policy error on the other side.
I wonder if we start to see this on the committee anytime soon, who've all been sharing the same speech over the last month or so, whether we start to see that dissent start to grow just a little bit more and show up in the minutes and elsewhere?
It's a great question, because right now we're hearing a very cohesive message, and perhaps this is to try to regain some credibility. But we're going to be speaking with Bill Dudley coming up, and he put out a column that really seems to echo what Mohamed El-Erian was saying over the weekend, which is the Fed made a mistake, and it needs to acknowledge its policy errors that is the cause of the reason why they have to go as hard as they do in terms of tightening policy now, and that if they are more transparent with that, it might regain the credibility that they need to make the steps necessary to bring this economy into the right way.
He wants a mea culpa from the Federal Reserve to explain why they've had to do 300 basis points worth of tightening in 6 months and possibly 400 basis points in 9. I get it. Bill is also asking, though, to convey more clearly the amount of pain that people should expect in the economy as well. I think it's very difficult to issue a mea culpa and then say, oh, and by the way, there's going to be a lot of pain because of what we did. Those two things make things even more uncomfortable for this Fed.
But perhaps it will achieve the outcome that they want. This is the perverse aspect of it. It will achieve the outcome that they want more quickly than if the market still doesn't buy that they have conviction in what they're doing.
Coming up, Bill Dudley, formerly of the New York Federal Reserve and now Bloomberg opinion columnist. This morning, he says the Federal Reserve owes the world a mea culpa. That conversation is coming up shortly. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Vladimir Putin is threatening more attacks against Ukrainian infrastructure after Russian missiles struck Kyiv and other cities today. The missile barrage was the most intense since the early days of the war. The attacks came after Putin blamed Ukraine for an explosion on a key bridge link between the Russian mainland and Crimea. Ukraine hasn't claimed responsibility, but within hours, it commemorated the blast with a new postage stamp. In the UK, Chancellor of the Exchequer, Kwasi Kwarteng, is taking steps to calm financial markets following a turbulent period. Kwarteng will announce his medium-term fiscal strategy and economic forecast on October 31st. That's more than 3 weeks before he had originally planned. Over in Germany, an advisory group is urging the government to subsidize as much as 80% of natural gas consumption for households and companies early next year. It would be part of a $194 billion aid package. The German government will review the recommendations and issue a decision in the coming weeks. It's another sign that North Korea is preparing for its first atomic test in 5 years. Kim Jong-un says he launched a new ballistic missile and simulated tactical nuclear strikes during recent military drills. Kim called the exercises a severe warning to the U.S. and its allies. Former Federal Reserve Chair Ben Bernanke is one of 3 people to share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond, and Philip Dybvig were honored for their research on banks and economic crises. The 3 will share an $885,000 award. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but you know, some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
So you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
Bloomberg has the biggest names in business. First, from the Greenwich Economic Forum in Connecticut, a global perspective on alternative investments with influencers from politics and finance. Then, Bloomberg Invest New York, where industry leaders discuss the challenges and opportunities in today's changing economic landscape. Coverage begins tomorrow, only on Bloomberg, your global business authority.
Fed has kind of entrenched themselves and kind of like, no matter what happens, we're going to do it, which I think is broadly the right message to be sending, but they should still be thinking with a little bit more nuance about, you know, what the data will say, et cetera, et cetera. But I think they've kind of painted themselves into a corner, which probably is a good corner to be in.
Ronnie Krosner there, former Fed governor, weighing in on the situation of the Federal Reserve. Premier of TD on Friday put it well, at least from her standpoint, that they're being tone deaf, and no matter what the data is, they'll keep on hiking.
Exactly, which is the reason why they're making a policy error on the front end and on the back end. That's the accusation from a lot of people who think that they're going to have to make a policy error on tightening too quickly because of the errors that they made, not raising rates
hard to look through
enough. Yeah, exactly.
An 8 handle on CPI if we get it again this Thursday, isn't it?
And this question around whether we've seen peak inflation, right? I mean,
Sure.
some people actually questioning that premise, not only with core, but even with headlines, should we get some sort of spike in energy prices heading into the winter?
Snoozy morning stateside in the market. Bond market's closed, equity market's not doing much, because what can the equity market do without the cues coming from the bond market, right?
Basically,
you know,
trust the bond.
Trust the bond market, is
yeah,
that right?
exactly.
That's
What did
if,
Marcus say?
If we're in fixed income. What did he say?
You need to respect the bonds.
Respect the bonds.
Respect the bonds.
No bonds open to respect. In Germany, there are. Yields up by 3 or 4 basis points on a 10-year to 2.23. Over in the UK, the gilt market at the long end up around about 20 basis points. Euro dollar 96.99, negative 0.5%. Spreads Italy versus Germany in and around 250 through much of this morning. Wides of the year. That might be a problem. Here's one for you from Bill Dudley, the headline of his latest piece. The Federal Reserve owes the world a mea culpa. Bill Dudley, Bloomberg opinion columnist and former New York Fed president, a good friend of this program as well, joined us right now. Bill, let's start there. A mea culpa. What do you want that to look like?
I think the Fed needs to explain to the world what went wrong. Why are we having to raise rates on 400 basis points this year, 4 percentage points this year? That's a huge amount of tightening in a short period of time, and is evidence that the Fed was very late. The Fed made a couple mistakes. Number one, how they implemented their 2% average inflation regime. They basically tied their hands and said we can't raise rates until a whole bunch of things happen. Number two, they made some important forecasting errors, both on inflation and on the tightness of the labor market. I think, doing a mea culpa, I think is important to basically build the Fed's credibility for the future. If you don't admit error, how can you be confident that the central bank won't make a whole nother mistake next time?
Bill, do you think they can do both that and do something which you asked them to do a number of weeks ago, which is to be much more open about the pain that this country, this economy is about to go through? And I wonder if they do both. You say it enhances credibility. Do you think it also invites questions about whether it should retain its independence?
Well, I think you want the central bank to retain its independence because you don't want monetary policy to be politicized. If monetary policy becomes politicized, you're going to have even worse monetary policy than we've gotten over the last couple of years.
Bill, on the flip side, there is an increasing chorus of big names saying that the Fed is moving to make a policy error on the other side by raising too far, that a deep recession is not an inevitability, but will be the consequence of them raising rates as much as they're expected to raise rates. Are you sympathetic to that view?
Well, I think that's a logical outcome of being very slow to tighten in the first place. If you've been slow to tighten, then you have to do a lot to catch up. If you do a lot to catch up, you may not notice that you've done more than that's actually sufficient. I think, hard landing is very likely because the labor market has gotten too tight. The Fed needs to push the unemployment rate up significantly, and that's likely to lead to a recession. I think it's almost inevitable at this point.
What's the economic benefit to the Fed coming out and being honest and saying what John was pointing out is a very difficult message to swallow, which is we made mistakes. Oh, and by the way, we're going to necessarily make a mistake on the other side, tighten into a hard landing. What does that give them in terms of credibility that can actually help ameliorate the cycle?
Well, I think that they are not going to say that we're going to tighten on purpose to generate a recession. I don't think you'd ever expect a central bank to say that. But I do think, Powell has now endorsed the notion that there is going to be some pain involved. I think what the Fed has not done, though, is admitted, how do we get into this mess in the first place? And I think that's the part of the message that the Fed needs to send to markets to build their credibility for the future.
Bill, credit to you. I remember doing a panel with you and Mohamed Al-Arian back in June, maybe May of 2021. And you were both making this point that the Fed needs to appreciate some two-way risk here, perhaps start by pulling back on QE. That would have meant maybe going 6 months earlier than they actually did, Bill. What difference would 6 months have made, do you think?
I think the advantage of going earlier is you wouldn't have to go as fast. You'd have more ability to assess the effects of your actions. Right now, they have to get to tighten very quickly. And given the long legs of monetary policy, this increases the risk that they overdo it. If you spread out the monetary policy tightening over a longer period of time, you have more time to assess the impact of your actions.
You've talked, Bill, about how you could see a peak Fed funds rate north of 5%. The market is coming to your view. You were out front that way. Right now, in the market, we have a nearly 4.7% terminal rate for next year. Where have you changed your view on where you think the Fed has to go in order to bring in inflation and honestly address some of the flaws of the previous thinking?
I don't think it's so much that the peak in rates has to be higher. I think the fact is the Fed has to hold that peak for a longer period of time. I think the Fed's strategy here is not to just keep hiking regardless of what's happening in terms of the real economy. But I think they want to go to a restrictive policy, and then they want to hold it there until they see clear signs that that's actually bringing inflation down and generating more slack in the U.S. labor market.
Hey, Bill, wonderful to catch up. Great read, as always, and good to have you on the program with us this morning. Bill Dudley there, the former New York Fed president, and now, of course, Bloomberg opinion columnist, amongst other things. Lisa, it's a tough one, isn't it? He's not the only one saying this, but if they do that, they come out, issue a mea culpa, say we got it wrong. Can you imagine how many more Senator Warrens are out there as the economy starts to roll over? And I think if you focus too much on the Federal Reserve, you're not focusing enough on some of the fiscal errors that were made over the last couple of years as well.
Agreed. In terms of additional rounds of stimulus that may not have gone to exactly the efforts that perhaps really helped reignite the economy, but just simply gave people money to spend at a time when the economy wasn't open. Lots of discussions that might be superseded by someone looking to blame someone, right? So this is why I asked, what is the economic benefit to coming out and saying we were wrong and we're going to be wrong again because we have to create some sort of stability here? This is the rock and the hard place, and the reason why policymakers do not usually come out and say we're heading toward a recession and it's our fault.
I understand the argument that it enhances credibility. And to trust the process, you've also got to believe that the people in control understand when they've made a mistake so they don't repeat them. It makes perfect sense to me. But I just think that it's more two-way, that you also invite a lot of criticism about the path forward.
The one argument, and this is something Bill Dudley has said in the past, is if there is more credibility, perhaps the market will move more in tandem with what the Fed is saying, and then you might get a more accurate read-through of policy.
It's the hopeful
Yeah,
aspect of
I
it,
mean,
right?
We gotta try.
Sure, no, I understand. Futures down 0.2% from New York. This is Bloomberg.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer, like Marriott's Leanie Oberg.
One of the most important things is looking around the corner.
Adrian Mitchell from Macy's.
We have to let go of the traditional legacy department store.
And Luca Zaramella at Mondelez.
We tend to believe that all consumers are equal. They are not.
Look for Chief Future Officer on Bloomberg.
The CPI in America coming up later this week. Then it's on to bank earnings on Friday with JP Morgan in focus. Before we get there this Monday morning, this is what the price action looks like on the S&P 500. Slightly negative on the S&P. We're down around about 0.1%. In the bond market, Treasuries closed. Yields higher in Germany by a couple of basis points to 221 on a 10-year. The spread between Italy and Germany this morning through 250 basis points. In and around the white of the year at 253. The Italian 10-year up by 4 basis points at 474. So the euro weaker by 1/3%. Euro dollar, Lisa, 97.13.
And how much lower could it go? And, you know, you were talking just a bit ago about the euro crisis and all of the parallels that we're seeing. At what point does this become a really difficult moment that requires a more extreme intervention? And what could that intervention be at a time when all responses are called into question in a new inflationary regime?
Whatever it takes, summer 2012, 6-handle, 4-handle right now. Hard to compare the two eras, the two bond markets, apples to apples, not quite, but it gives you an idea of where we are now versus where we were then.
And then this goes to how much can this particular debt cycle withstand a 6% rate? And I get your point that a lot of companies, a lot of nations have pushed out maturities. Is that good enough?
Resilience.
Right?
Don't you see that word everywhere?
Everywhere.
In Southside research, resilience.
Resilience.
It's more resilient than it was.
Is it just delayed? Is it a delayed reaction? Is it resilience or delayed?
Gilles Moe is going to join us now. Feels like Euro crisis all over again, except it's different. Chief economist at AXA Investment Managers. Gilles, let's start there. Let's just start with the key differences between what we're facing now and what we faced back then.
Well, first of all, at the time we had massive external imbalances in the periphery. We had massive current account deficits. So you had an issue with the government, but you had an issue with the way the entire economy was working in the south of Europe. You don't have that now. Those countries have really done a good job at reestablishing a proper external position. The other big difference is that we have different instruments. The big issue we had in 2011 is that there was nothing in the arsenal that you could use to actually stop this. We didn't have the ESM, we didn't have an ECB, which after that has proved its flexibility. So there was this scramble to finding institutional solutions in just a matter of months. Now at least we know that we can rely on those emergency mechanisms if things get to the point that we need to use them. And I think the market knows it, and that explains. It's one of the reasons why we haven't seen, for instance, a lot of contagion moving away from Italy and affecting other countries in the south. We know that the instruments are there.
They came up with OMT with Draghi in the summer of 2012, and the beauty of OMT is it never got activated, never had to be used. This summer they came up with TPI, the Transmission Protection Instrument. Is that right?
Yes.
TPI? Okay. When does TPI start to become a real consideration? 250 basis points of spread right now. I'm just trying to wonder, what's the threshold when that starts to kick in?
They've never been clear on this, and they don't want to be clear on this. I'm talking about the ECB, obviously. There's an awful lot of discretion there. My guess is that it's not just a case of the level of the spread or the level of interest rates, it's the speed at which things are moving, and so far it's been fairly contained. The biggest issue for me with TPI is actually not of a technical nature, it's political. The way TPI has been designed, it's definitely not done in a way that would protect the government against its own mistakes. And that's the issue. If you could come up with a situation where the market is punishing a state for things which it has not even done or announced, then TPI is probably there. If a government is doing stuff which is triggering a sort of rational reaction by the market, then TPI is probably not the right instrument, and then you need to go to MT. But so far, at least, the news that we have from Italy, which is the biggest issue in there, is that the government, the new government, we don't have one yet, but the noises we got from the new majority is that they want to be prudent. So if they don't make big policy announcements that would make the ECB nervous, they could actually benefit from TPI. And there's the relationship with the market that you can build on that.
I just can hear your voice in my head right now.
What's that?
I can
What am I
hear
saying?
Jonathan. You're saying,
mind reading
yeah, you're mind reading Jonathan because it's very loud right now. And he's saying, okay, so they're going to talk about political risk in the peripheries. What about the fact that Germany is the biggest risk right now to the entire European economy and some of these
I don't know how you strip out the two things.
So there you go. So what's the answer? How is this situation different, both with the political considerations and from just distinguishing from the Euro crisis of 2010, considering that Germany is one of the biggest problems, one of the biggest downside risks to the entire economic outlook?
Germany is clearly one of the biggest downside risks to the macro story, but it's also the country which has the widest policy space. and they are using their policy space quite a lot. I mean, you've seen the announcements that we had last week from the German government. They still can mitigate a lot of the current pressure that they get from gas prices with the billions that they are about to spend. So in this case, yes, it's quite negative of the last 2-3 quarters. A recession in Germany is absolutely unavoidable, I think, at this stage. But we know that they can deal with this on their own forces, which is not something that we have in other countries. That's the big difference.
Although you do have to wonder how much higher inflation is going to be for a longer period of time, given the fiscal response in Germany, and that the political pressure from the peripheral regions will say, if you guys can have such a big fiscal response, we can too, because you're going to just let us, suffer as we finance your deficit by bringing down the cost of your financing through a weaker euro?
A key issue there, I think, is whether all this triggers another round of debt mutualization in Europe, which is definitely what we need to see. When we had a pandemic, we ended up with debt mutualization. It was partial, obviously, it was the Next Generation Pact, but we did it. I'm a bit surprised and disappointed that we haven't seen more progress on debt, another round of debt mutualization to deal with the fallout from the Ukraine war. But there's going to be a point where we will get there. I mean, Europe is always tiring for external observers because it takes so much time to get to the right solutions. But I'm quite convinced that if we get to a situation where we will see bigger cracks appearing in our fabric, you will see this further movement of debt mutualization. You will see actually a capacity from the EU as an entity to provide support to the most fragile countries. We've done this with Italy with the Next Generation Pact. Fourth time being, it's not done to deal with the fallout of the Ukraine war, but I really have no doubt that we would get there if need be.
Let's talk about the cracks right now. The mystery for many of us, the ECB, why is it not forecasting a recession? How on earth are they not forecasting a recession in the Eurozone?
Now, I was very surprised, and then I reminded myself of my time when I was in central banking. You probably don't want to be the one, validating market expectations of a recession. You probably don't want to add to the general bleakness in the system by coming up with a very scary forecast. I guess it's part of what central banks usually do. I noticed that in the US, the Fed has taken an awful lot of time before saying that, yes, maybe unemployment would have to rise to get inflation back under control. Well, it's a bit the same in Europe. Central bank very rarely want to be at the bottom of the distribution when it comes to forecasts.
Sure, except that there is a credibility issue, that the central banks will go through with the tightening plans that they're projecting, because casual observers would say, well, you put A plus B together, you get recession. And they're saying, no, A plus B equals roses and lots of beautiful things. So at what point does that undermine the faith that they will continue with their tightening cycle?
Well, they don't deny the risk of the recession, to be fair. We didn't have a super rosy message coming from the ECB, but they're in a complicated position because, and that's a big difference with the US, inflation in Europe is not essentially domestically driven. It's none of our fault to summarize. And we have an ECB which is forced into a tightening to keep inflation expectations anchored in a situation of massively adverse supply side shock. It's not an easy thing to explain, especially if we've spent the last 20 years, not just in Europe, but also in the US, explaining to stakeholders in the real economy and also in the markets that, you know what, central banks have your back. And this time, no, sorry, central banks cannot have your back because there's an inflation issue, there's an inflation expectations issue, and central banks are not going to be your friend. It's incredibly complicated to explain, again, coming after 20 years of monetary policies which have been extraordinarily accommodative.
They're delaying the inevitable, though, aren't they? They'll have to confront this at some point. They're talking about raising interest rates.
Lost.
A lot of people assume that by the end of the year, this is the economic situation we're looking at, whether they forecasted it or not. Can they keep on hiking, as the numbers clearly show this economy is in recession?
Yeah, my point is that I think there's already a debate actually at the ECB, which is for now not having a direct impact on their immediate decisions. They all agree on the idea that our monetary stance was super accommodative. You bring it, let's say, to the upper end of the neutral range. And then this is where the differences appear. You have those who are going to say, I don't care, I just continue hiking as long as inflation's there. And others, and I would probably agree with those who would say, look, once we've brought our policy rate at the upper end of the neutral range, let's stop a while, let's pause, and let's see how things happen. But for the time being, there is an alignment, actually, of doves and hawks around this idea that, in any case, our stance was far too accommodative to start with. So I don't expect, actually, this debate to really trigger, to really have an impact on decisions before the very end of this year. In the meantime, it's, as JP will say, they will keep at it.
Are you feeling the pain of euro-dollar parity personally yet in your first few days of being here?
I'm certainly not the most vulnerable person on earth, but yeah, I've been in New York for 2 days now, and yeah, you feel that your coffee is much more expensive.
It's a change.
Indeed. Yes.
It's a shock. Bramo, I took the other side of the trade, going over to Europe, and it feels so much better.
It's so great.
Isn't it great?
Everything's on sale. It's so exciting.
For Americans going over, Jill, it's a fantastic time.
Please, we need you.
I know.
We need American tourists.
It was there in the summer, and everywhere you went, I just heard American accents.
Everywhere.
American accents pretty much everywhere. Jean-Marc, thank you, sir. It's good to see you. We're Maxa Investment Managers, and I know you're going down to the IMF meeting, so enjoy. Even though they might be a little bit gloomy. You did read my mind, by the way.
I mean, it was very loud.
Which is clearly very easy to do.
No, I'm just saying that particular point that you've made is well taken.
Sure.
And it's an important one. And the biggest difference between the Eurozone crisis back in 2010 and now, where is the crisis? It has changed.
In a big way.
Yeah.
Coming up on this program in the next hour on Bloomberg TV as we count you down towards the opening bell. We'll catch up with Andrew Balls of PIMCO. Looking forward to doing that. Live from New York City this morning. Good morning. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russian missiles hit Kyiv and other Ukrainian cities today in the most intense barrage since the early days of the invasion. And Vladimir Putin threatened further attacks, warning that the action would be harsh. That came after Putin blamed Ukraine for an explosion that damaged a key road and rail bridge connecting Crimea with Russia. Ukraine hasn't acknowledged it was responsible for that. Former Federal Reserve Chair Ben Bernanke and 2 U.S.-based colleagues share this year's Nobel Prize in Economics. Bernanke, Douglas Diamond, and Philip Dybvig were honored for their research on banks and economic crises. The Nobel Prize Committee says the three improve the understanding of the role of banks, as well as how to regulate financial markets. The Bank of England has expanded its emergency support for the UK bond market. Its new steps to support gilts beyond this week are designed to broaden purchases. The BOE started the bond buying last month after market turmoil caused by the government's unfunded tax cuts. The UK's financial watchdog is asking banks more questions about their staff's use of private messaging services. And that's after U.S. regulators handed over more than $2 billion in penalties to some of the world's largest banks. The Financial Conduct Authority has asked a number of banks about staff exchanges through texting and apps like WhatsApp. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. it's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
We do expect the market to remain volatile. You know, these rallies that we're seeing, we continue to expect them to fade. I mean, the Fed remains determined to bring down inflation, and they have been clear to us that they will not blink nor even wink. And so even at the expense of
Nadia Lovell, senior U.S. equity strategist at UBS Global Wealth Management, speaking with us on Friday. A big day that really gave people a sense that the economy would be able to withstand whatever the Fed had for it. And then we get some news later that day where you have President Biden come out and announce some potential restrictions on semiconductor and chip technology being exported from the U.S. to China. The big fear is, where are we headed in an economic war based in the semiconductor space? Mandeep Singh covers the semiconductor space for a senior technology analyst at Bloomberg Intelligence, joining us here. Mandeep, right now I'm looking at AMD shares in the U.S., pre-market trading down 1.7% across the board. This is being viewed by the market as a negative. How much is this a negative for U.S. earnings, and how much is this a broader negative that has not yet been realized?
Well, so look, they pre-announced last week, and the focus was on weakness in the client segment, which is the PCs, where we think there was a pull forward. I think what remains to be seen is what will happen to the data centers, which has held well, which is the reason why AMD's gross margins have gone up. And look, we have already seen about 20% negative revisions on the top line. That will trickle down to the bottom line. So that has already transpired in terms of estimate cuts.
But aside from just AMD, just on a broader level, the semiconductor space in the United States and beyond has suffered dramatically this year, at least with shares down about 40%. How much has yet to be realized with an escalating conflict between the U.S. and China?
Well, so we've seen kind of a similar situation with the tariff wars back in 2018-19. And what could potentially happen here is similar to what happened to Huawei. there will be one company that will be kind of at the forefront of this that could really suffer. We don't know who that could be. But I think where US is going is they want to restrict access to software that Chinese companies use to design, supercomputers, their latest chips, as well as the semi-cap equipment. And so once that happens, it kind of limits China's ability to go to the latest process nodes, which is what they want to get to in terms of, the self-sufficiency around semiconductors. But how that translates into NVIDIA or AMD's outlook, it remains to be seen.
What kinds of retaliation could we expect to see from China in response?
Well, so look at NVIDIA, for example. They have about a 25 to 30% revenue exposure to Chinese customers. Now, a lot of those customers give that, packet chips back to an entity or a US-based company. So clearly, it will trickle down. But there are Chinese customers that will be impacted, and that will have, a cascading effect in terms of what that will do down the line.
How significant of a deal is this? Because when I read this on Friday, that this came out, I thought this was a pretty big escalation in something that we've been hearing all year. How did you view it?
Well, so this one in particular was focused on the leading nodes. And what I mean by that is China is trying to create their own supercomputers. They want to be in the lead when it comes to the latest, AI and machine learning and all the kind of the latest servers that they can design. So that's where this particular ban was focused on. Now, what could happen is because China feels like they don't have access to anything, they could impose a certain ban on a US-based company. And that's what I mean by if things escalate, you will see a real kind of dire situation where the US companies are also impacted in terms of their ability to do things.
You were talking earlier about the forward guidance that we heard out of some of the semiconductor companies in the US and beyond and how negative some of those forecasts are. How significant is this for the broader PC, the broader smartphone industry that could really be foreshadowing what we could expect to see from Apple and Google and everyone as they report earnings?
Yeah, so this earnings season, we expect more negative revisions following the earnings. We've already seen in anticipation, but you are going to see more of that. And look, with chips, there are certain pockets that are still seeing very strong demand. We are still in shortages when it comes to auto chips and more or less on the data center side when it comes to high performance computing. But others such as, smartphones, PCs, that's where we are seeing a real deceleration, inventory buildup, and you're going to see inventory write-downs, which is what we saw with AMD and Intel before.
Has this been priced in?
I think with AMD, it is. I mean, you see the stock is down over 50%, so it's in anticipation of that weakness in the client segment. Intel, we know they've been down, and the stock continues to go down. So more or less, it's priced in, but at the same time, with chips, the pendulum always swings extreme. And this time will be no different in terms of, the boom and bust we typically see. So chips are a very cyclical sector, and that hasn't changed.
We also are hearing a lot more with specific companies building out foundries in a number of places, with the announcement of upstate New York being the latest place where one's going to be built. How much more onshoring is there going to be, especially as this becomes the epicenter of ongoing conflict internationally?
Look, chip manufacturing is, asset intensive. You need to kind of build the CapEx over time, and that's where Intel is constantly trying to get money from the US government, other governments, and the fabs take time to come online. So it'll be 3 to 5 years before we start seeing manufacturing actually happen in those fabs. But bottom line is, if you get to a point where you have capacity and the utilization, that's key. If it's over 70 to 80%, that's when it becomes a good business for Intel or Global Foundries or anybody who's based in the US.
How much more inquiries do you get these days than in the past? And I ask this because a lot of people are saying, this is the telltale sign. This is the area to watch. Check out how big Apple is, as a component of the overall index. Look at how significant this is. Look at the move here. This indicates what's to come. How many calls like that do you get?
Well, we get a lot of that in the sense everyone wants to know what's the worst case scenario right now. And that's how, the markets work. Even though it's a low probability outcome, they want to know that. So TSMC in China is a big factor. So even though they're trying to move stuff out of China into Vietnam and India, But it's still, the worst case scenario is pretty extreme here in terms of the stock outcome.
So going forward, which company are you most focused on in terms of a possible surprise?
Well, so NVIDIA is the one that trades at the highest multiple in that group, 11 times sales. The expectations are high. Everyone thinks they will continue to do well on the data center side. But with data center, you will see a cloud digestion phase. Remember, the data center spend is all from 7 or 8 hyperscale cloud guys. And they will pare back. They've been spending, above capacity for a while because the demand was so huge in terms of digital transformation and post-pandemic event. They will cut back. There will be a digestion phase, and then things will resume. But when that digestion phase happens, I think NVIDIA is probably at the forefront of that exposure.
Mandeep Singh, thank you so much for being with us, and good luck with all of those worst-case scenarios that people are looking to find out. I can empathize with that. Just what's my base case? What's my bear case? Coming up on Balance of Power on Bloomberg TV and Radio, Wendy Cutler, Vice President and Managing Director at the Asia Society, as we continue to digest the ongoing ratcheting up in tensions, what some people are calling the economic war with semiconductor at the heart of it. From New York, this is Bloomberg Surveillance.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech and sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
You will put a woman on Mars. You will bring forth global cooling. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
For a young person who now is looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
Three-day losing streak coming into Monday, big week coming right up. Live from New York City this morning. Good morning, good morning. Future's just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue, earnings season kicking off.
Earnings.
Corporate earnings.
Q3 earnings.
We're going to look for guidance from CEOs and CFOs.
Investors are looking for outlook.
Investors want to hear management speak.
A lot of companies have failed to provide outlook and any guidance and certainty.
How are they going to maintain margins?
How much corporate earnings are being hurt by interest rate rises?
How are they going to navigate this incredibly difficult and very rapidly changing economic environment?
And how much corporations are able to pass on the effect of higher inflation?
We've had big markdowns on earnings. We're expecting a lot of revenues and profits to be hit.
We're going to start to see companies generating negative operating cash flow.
That is the next thing that the market has to focus on.
That's really going to be the next trigger in terms of the market coming under pressure.
Joining us now to discuss is Flowbank's Esty Dweck. Nuveen's Tony Rodriguez. Esty, first to you. Charles Evans of the Chicago Fed right now saying optimistic we can reduce inflation and avoid recession. Do you think that optimism is misplaced?
Well, at this point, not yet. Although the more the Fed tightens, the tougher it's going to be with a soft landing. We are seeing tentative cracks in the labor market, not quite in the non-farm payrolls, but the jolts finally came down a little bit. We're seeing some softening in growth, but at the same time, consumption seems to be holding up pretty well. And as we said, unemployment is holding up. So far a decent mix for the Fed. But if inflation doesn't come down over the next couple of months, they're going to continue to tighten pretty aggressively, and that could definitely have pretty bad effects for 2023.
And perhaps 4.5% is as far as they'll go. Tony, that's what Charles Evans is saying right now. Back in rates around 4.5% in 23 and on hold for some time. What's the some time? How long?
Well, good morning, Jonathan. Good to be with you. And while I appreciate Charles's optimism, it may be a little bit too much of rainbows and unicorns. So I think 4.5 is a possibility. We would say 4.75 is more likely, but we do think that they're likely to hold throughout 2023. So while we think the economy is going to be in recession, we think it'll be a relatively mild recession, and we think that the Fed will actually pivot to rate cuts sometime in early 2024.
2023 up to 475 and hold through much of next year. Esty, plug that into what this would mean for the equity market. If we went to 475 through much of next year, how much pain would we see?
Well, the futures market is already pricing somewhere between 4.5 and 4.6. So 4.75 is a bit above where we are. I think as long as we don't hit that 5% mark or more, the market is pretty much pricing most of it in and should be able to withstand it. We've seen earnings expectations come down, not just for this earnings season, but also for 2023. Right now, we still have those rate cuts priced in for the end of 2023, but it's still a little early to say that the Fed would not look through that. That's, over 12 months to get inflation back to 2% and then potentially see what the growth impact is and if the economy needs some help to come out either of a shallow recession or of a very sharp slowdown. In any case, that's what they're going to engineer. So right now, the market's probably pricing in something close to that. Anything much more hawkish for longer, I think, would be quite painful.
Esty, last time we spoke, you thought the June lows would hold. They didn't. What went wrong, do you think?
Well, I think a couple of hot inflation prints really was the worst of it. And the market, I guess, was expecting a pivot. I don't know who thought we would pivot to dovish. I mean, pivoting to a pause or to see what the rate hikes are doing. Let's keep in mind, this is the fastest pace of rate hikes the Fed has ever done. At some point, they need to see what the impact is You don't see that after 1 month. So we're going to have, 4% of hikes within 6 to 9 months, and the Fed is going to have a look at that too.
Futures up 1/3 of 1% on the S&P, and the Nasdaq up 0.2%. CPI is just going to hijack the conversation later this week with regards to the Federal Reserve. Then it's on to corporate America. JP Morgan on Friday morning. These corporations, corporate America right now, has to face a growing list of headwinds. Relentless monetary tightening, a surging dollar, and an incoming read on inflation, all weighing on sentiment. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Yeah, it's not a great cocktail for corporate profitability, and we're going to get our first reads on that really coming this week. Along with JP Morgan, you have 14 other S&P companies reporting this week. The bulk of them, though, will come in the weeks to follow. Between the week of October 24th and October 31st, you have about 2/3 of the market cap and members of the S&P 500 reporting. So buckle up. It's going to be a bit of a long ride. But to your point, John, given all of the headwinds that these companies are facing, we have seen a deterioration in expectations for this earnings season the closer we get to it. Back in mid-August, about 2 months ago, analysts expected EPS growth of about 4.3% for the S&P. That number is down now to 2.6%. So definitely a slowdown compared to what we saw in the first and second quarters. But analysts are still betting that these third quarter results will represent the trough, with a rebound starting in the fourth quarter. We'll see how long, though, that optimism can hold up, considering we have seen things start to deteriorate in sell-side expectations. Analyst earning downgrades outpacing upgrades for 17 weeks in a row through the data we have at the end of September. And we've heard from a number of strategists consistently on the street who are warning we have not seen the worst of the downgrades yet, that more are on their way. And I would just point out, in our latest MLive survey released this morning, that poll survey showed more than 60% of more than 700 respondents say this earnings season will push the S&P lower, John.
Kelly Lyons, thank you. Tons of warnings this morning, including another one from Morgan Stanley's Mike Wilson, who said the following: last week packed in a year's worth of volatility, both up and down, as the market battle between deteriorating fundamentals and supportive technicals continues. Ultimately, fundamentals prevail, in our view, but it could take longer than we would like. Esty, I'd love your view on the earnings season going into the big banks this Friday.
Well, everyone is expecting it to be poor. Earnings expectations have come down. Everyone thinks this Q3 is going to be the opportunity for guidance to be poor, for 2023 expectations to be brought down. The question really is how much is already priced in at this point of this bad news that pretty much everyone knows is coming. So I think we're going to get, of course, some pretty bad surprises. Let's say something, around what the FedEx said, although it's difficult to imagine much worse than the guidance that they gave. But I think we're also going to have a couple of beats, as we usually have. Tech should hold up better. And then the banks, so far we've seen that consumers are holding up. There's a little bit more of an impact at the lowest wage earners because of inflation. But beyond that, we're still seeing some solidity in the underlying consumption trend.
Tony, it's not a secret, is it? Things are bad. That's what Esty's getting at here. If the World Bank president and the IMF managing director are saying it, we're already there, and we were there a long time ago. The IMF managing director early this morning, Kristalina Georgieva, saying the risk of recession has gone up. Mr. Malpass, President Malpass at the World Bank, saying a real danger of a global recession. I think at this point, Tony, this is all well understood. How well priced is it?
Well, John, you bring up a good point. From our perspective, what's interesting is that we do think that the rates markets have priced in the vast majority of the moves. So when we look at the 10-year, the 2-year, where Fed funds futures are priced, we think that we've really captured the majority of the move and are much more comfortable now from a standpoint of duration risk. Where we still see some more downside and don't think that the markets have fully priced in that downside is when we look at risk markets. We think that while earnings projections, as Kaylee pointed out, have come down, we do think they still have further to go. We still think it's a little bit too optimistic when you look at Q4 and when you look at the first half of 2023 from an earnings perspective. So we think risk premiums need to price in some more downside risk. So that is probably lower equities. It's also wider spreads when we look at high yield, emerging markets, investment grade fixed income. As we move through the balance of this year and the first quarter of 2023, we think you'll have some better entry points. We don't think they're going to be a repeat of the global financial crisis type of downside levels, but we do think you have a little bit more downside still ahead of us.
Tony, I think a lot of people would take some comfort, just a little bit of comfort, if the positive correlation between equities and bonds actually broke down. When can I start looking at a long bond that starts to behave like a long bond in a recession?
We think that as you turn the calendar that you really will be back to that more maybe traditional, typical bond market response and offset to your equity portfolio. We certainly think over the balance of this year, whether it's a strong CPI print possibly or some employment data that's maybe stronger, there's still a potential for a little bit of an increase further from here in rates, but we don't see the 10-year much above 4% at all. We think that we'll end closer to 3.5%. And more importantly, we think that as that economic weakness in 23 becomes very apparent to investors, we're looking at a year-end 23 10-year that will be down much closer to 3% than it is even to 3.5 or 4. So that's when duration risk in the bond market will begin to play the balanced role in your portfolio.
Tony, are you starting to lean into a little bit of duration, or is it too early?
Well, Jonathan, as you know, we've been pretty short from a duration perspective for the entire year. We're now pretty close to neutral. So we're not ready yet to say, hey, we've seen the peak in yields and we want to get long here, but we certainly leaned into it enough to cover our shorts and get pretty close to neutral because, as I said, we think that 90+% of the rate move is priced in.
Tony Rodriguez sticking with us alongside SD Dweck. B of A just published moments ago. Bank of America on their equity strategy team saying the following: consensus feedback from clients. Third quarter might hold up, but who cares? Guidance is going to be absolutely terrible. They go on to say, we expect a slight 1% miss in 3Q, but big downside risk starting in 4Q. We forecast $200 in 23 EPS versus the street at $240. We'll build on that in just a moment. Coming up, the BOE launching new safety net measures to calm the bond market.
The Bank of England is in a very tight spot. Eventually, it's going to have to stop buying those bonds and start going for QT.
And you'll get a fiscal announcement at the end of this month, a few days before the Bank of England meets. That conversation up next.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
Welcome
to Bloomberg, the lineup.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
The Bank of England is in a very tight spot.
We have no direction yet on the future course of UK fiscal policy.
It's almost a kind of they'll do whatever it takes period of time.
It did the right thing, we think, by protecting the pension funds at very short notice. Eventually, it's going to have to stop buying those bonds and start going for QT. There is value in the UK market. It's just a question if that value will be destroyed by political risk.
The UK ramping up efforts to ease market turmoil. The Bank of England expanding its emergency support for the bond market, just as the government announces plans to deliver its fiscal strategy almost a month ahead of schedule. Team coverage starts right now with Danny Berger out of London and Kelly Lyons here in New York. Danny, run us through the latest.
Well, so we had the BOE essentially expanding these operations. So they're going to double the amount of daily auction that they can buy. It was £5 billion. It's now going to be up to £10 billion. Of course, only $5 billion of the $40 billion on offer so far has been used. So not a lot of usage, and that will still end on Friday. But it's not going to stop there. They are launching this temporary repo facility. The idea here being that those who need liquidity, especially those pensions under pressure, can tap this. They can also use collateral that goes beyond bonds. For example, they can put up corporate debt as well. Now, it's a 1-2 punch of the BOE and the UK Treasury trying to get ahead to calm markets. We also learned today that Kwasi Kwarteng is going to be publishing that fiscal agenda on the 31st of October. That's moving it up from November 27th. So now it's going to be ahead of the BOE decision. But still, John, it's going to come the same day that QT is set to start.
The gilt market's still all over the place. Kelly Lyons, your 10-year at 14 basis points.
Yeah, the reaction to the news of the BOE expanding this program is just yields higher. Granted, we are off of session highs. At one point, the 30-year gilt yield was up 22 basis points on the day. We're now up just about 15 basis points, but still at 453. We remain around the highest level we have seen going all the way back to 2011. One strategist over at TD telling Bloomberg that essentially the market is doubting if the BOE is going to fill the maximum number of orders. And also the fact that they're announcing these new measures today kind of signals that they aren't going to have any kind of extension on this emergency temporary bond buying program. Now, of course, over the last month, the moves have been even more dramatic. We're up 106 basis points on the 30-year on the month, up 146 on the 2-year at the same time that we've seen more weakness in the British pound off of its weakest levels from a few weeks ago, but still around 110. And as Danny alluded to, it's not just about October 31st. It's about what happens just a few days later on November 3rd when we get the rate decision from the BOE. And the market is expecting it to be less aggressive than thought just a few weeks ago. Right now, Andrew Bailey and co. are sitting at 225. They are now expected to hike to around the 338 levels. So essentially, the market is pricing in a 68% probability of a 125 basis point hike. Massive move, no doubt about it, but that is still less severe than markets thought a few weeks ago when we were discussing the likelihood potentially of an inter-meeting hike, John.
Danny, let's talk about the calendar now as it stands. So Kelly just went through fiscal announcement end of the month, November 3rd, the Bank of England. You said it. QT, the end of the month, on the same day that they deliver that budget. Danny, is that actually going to happen? Does anyone you speak to believe it will?
No, to put it simply, John. We were just playing sound there from Altaf Kassam of State Street, who I spoke to earlier, and said, no, there's no way the BOE is going to be able to go ahead with QT. If they are now being pushed around by the bond vigilantes, we're already seeing it today. Kaylee pointed it out. This is a market that is testing the BOE. What will that test look like if they're going to have QT and a budget announced on the 31st? Look, it could happen that the budget comes out. It's clear that the deficit will come down. But considering the volatility as of late, this is a very fragile market. So you have the bond buying ending on Friday. You have QT and the new budget on the 31st, a rate decision then on November 3rd, followed shortly by other central bank decisions. And then this repo, that will stop, at least for the time being, on November 10th. John, a lot of potential risk events.
Danny, thank you. Looking forward to your coverage through the week as well. To Kelly Lyons, thank you very much as well. Jeffries had this to say. Long end gilts are coming dangerously close to levels where we could again see margin calls. They went on to say, and forced selling from liability-driven investment accounts. The BOE will need to step up the purchases this week to prevent further margin calls. Tony, are you interested in the gilt market just yet, or is this one still too volatile to touch?
You know, Jonathan, our head is spinning given the number of policy U-turns that you're seeing in the UK, both in fiscal and monetary policy. So we think that clearly it is too difficult right now. The volatility is too high to take any kind of really definitive position in that market. You mentioned a year's worth of volatility in 1 week in the equity market. In the UK, they've had a generation worth of volatility in the rates market in the last couple of weeks. So we think all this does is delay the BOE's need to address incredibly high inflation. So the problems in the UK are not being resolved by any of these policies, obviously. And the BOE's main problem is just becoming more and more difficult as we move through the year, given that they can't address it directly because of the volatility they're seeing in the rates markets.
It's taken some attention away from what's been happening elsewhere. I think we've all been looking at spreads in Italy, over Germany, through this morning, through the wides of the year, a little bit early this morning, back to about 251 basis points, call it 252. Esty, right now, the Italian 10-year, just through 470. Is that becoming a bigger and bigger problem that the ECB might have to address and soon?
Well, I think that's what the bond market would like, right? Since they announced their new tool, everyone's been wondering how and if Italy would become eligible. Let's not forget that financial stability is an outright objective and part of the ECB's mandate. So if it becomes too unruly, if it becomes too problematic for Italy or for the rest of the European Union as a whole, you'd have to imagine they're going to act. As long as it remains orderly for now, they might allow it for some time, but the ECB is certainly going to have to give a lot more details on all these different policy tools and how they're going to address the spread widening to maintain this financial stability. In addition, because they're going to have to keep tightening to bring that inflation level down.
Tony, we've spent a long time now talking about policy and conflict between monetary policy authorities and what's happening on the inflation side and what's happening on the financial stability side. Can they achieve financial stability and get inflation down at the same time? Because at the moment, everything's very, very confusing, Tony. Rates up, maintaining some form of bond buying simultaneously. With that in mind, Tony, when does the Italian 10-year become a buy?
You know, Jonathan, our view has been that at this 250 level, it really begins to get the attention of the ECB. As we get closer to 300, we think the jawboning will begin in earnest. Once you get above 300 and that 3 to 350, that's when they're going to need to start actually talking about specific plans potentially to address that. If we get over 350, then we actually think they will begin to inject themselves in the market. So it's too early right now, we think, given all of the volatility and uncertainty, to make a stand on that Italian-German spread. But we think once you get to 300, that 300 area, it becomes a lot more interesting and needs to be evaluated carefully.
Well, let's set the scene for the end of this month. October 27th, Esty, is when the ECB next meets. Can they go 75 basis points month end?
You know, they can. They have inflation close to 10%. We'll see what the German number comes out as relatively, I think, in the next couple of days. Yeah, let's not forget that part of the mess in the bond market, including what's happening in Italy, is also kind of contagion from the UK. So we are not seeing a lot of stability, but this is not all about Italy. We haven't seen that many headlines since Mrs. Meloni became prime minister. So the ECB certainly needs to act to contain inflation. They know that the growth prospects are poor. Obviously, the escalation in the war in the Ukraine isn't helpful for inflation or for growth, but they could go 75 because they definitely need to address it.
Esty Dweck, Tony Rodriguez, to the two of you, thank you. Some big central bank decisions coming up in the next 30 days or so, the next 4 weeks. The Bank of England being one, the ECB another, the Federal Reserve. Make it 3. Right now, the spread of Italy over Germany, 252 or 253 basis points or so. The yield on the Italian 10-year, 473, up a couple of basis points on a session. Coming up, the morning calls, and later, PIMCO's Andrew Bulls, seeing a more compelling case for bonds. We'll get his view on just that in just a moment around the opening bow. Going into the opening bow, 6 or 7 minutes away. Futures are positive about 0.25% on the S&P 500. We're up by around about 9 points. Live from New York, this is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
5 minutes away from the opening. Dow futures just about positive on the S&P, up around about 0.25% on a 3-day losing streak coming into Monday. On the S&P 500 on Friday, biggest one-day move lower on the S&P going back to the middle of September. The same day we got last month's CPI report. Last month's CPI report, the next one coming up a little bit later this week. Looking at the bond market, remember the Treasury market closed today for Columbus Day, so you look to Europe where yields are just shifting a little bit higher, and that spread between Italy and Germany gets a little bit wider through much of this morning. That level in and around 250. That's the price action. Here's some morning calls. First up, UBS downgrading Ford to sell, $10 price target, seeing little upside amid weakening profit margins and more macro headwinds. That stock is negative by more than 6% in the pre-market. Morgan Stanley cutting its price targets on Meta and Alphabet, citing low visibility for the digital advertising market. That stock on Alphabet is basically unchanged. And finally, Guggenheim upgrading Merck to buy, highlighting positive results from the drug maker's clinical trials. That stock is up by a little more than 2%. Coming up, stocks attempting to snap a 3-day losing streak on the S&P 500. We'll catch up with PIMCO's Andrew Bulls, expecting further downside to equities as the bond market starts looking a little bit more compelling. We'll get PIMCO's cyclical outlook next. From New York City this morning, good morning to you all, with futures on the S&P 500 shaping up as follows, advancing around about 1/3%. Your cash open just around the corner.
Most of us don't spend much time thinking about the grid, the dizzyingly huge system of cables, transformers, and outlets that reliably powers our lives. It's an easily ignored, change-resistant part of the modern world, and that's the way we like it. But as we move towards less planet-melting ways of producing electricity, the grid is going to have to evolve too.
We are seeing so many countries and governments announcing high targets when it comes to decarbonization and being climate neutral. But this is just one side of the coin. It's not enough to simply generate green energy. We also need to make sure that this is transmitted and distributed to the end consumers.
The grid of today just isn't equipped for renewables. So a new kind of grid is starting to take shape. The supergrid.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
23 seconds away from the opening pound this morning. Good morning to you. Three-day losing streak coming into Monday on the S&P 500. Looking to snap that with futures positive about 1/4%. Call it 1/3 of 1% higher on the S&P. On the Nasdaq 100, up by almost 1/10 of 1%. As your opening pound, switch on the board and get to the bond market. Take a look at not treasuries, take a look at bonds. Treasuries closed today, back open tomorrow, of course. In the bond market, just like treasuries, yields have been climbing on a 10-year maturity for 10 consecutive weeks. Right now, 220 on a German 10-year. In the FX market, with the spread between Italy and Germany that little bit wider and going through the wides of the year earlier this morning, euro-dollar breaking down by 0.4 of 1%. Earlier on, 96 handle on euro-dollar. Right now, just about holding on to 97. In the crude market, monster rally through last week. WTI coming back down by 0.2 of 1%, $92 and around about 50 cents. Let's get you some movers. Let's do that with Abby. Morning, Abby.
Hey, John. Well, let's start out with some movers to the downside going in the opposite direction of this possible update, the first update in 4. And of course, Ford is plunging this on a downgrade over at UBS to sell on weak profit margins, also along with a tough macro background. Rivian also down sharply, down about 5.4%. They've recalled 13,000 vehicles to check a minor structural flaw. This just after they sorted out some of their production issues. And then Wynn Resorts down 3.2%. There was a weak holiday spending during China's Golden Week. So they are taking in their sales estimates. Those aren't the only movers, though, that are dropping this morning and this year related to China. Of course, the U.S. Commerce Department is rolling out sweeping new limits on tech sales to China. This, of course, could cause long-term ripples. Now, chips, as you know, John, are already in a world of hurt. The overall index down about 40% on the year. Big companies pre-announcing AMD last week, down more than 10% on the day. NVIDIA over the summer. These new restrictions will not help. These tensions could really build. And on the day, we're not seeing the kind of declines that we've seen more recently, those double-digit declines. But nonetheless, AMD down about 1%, on Semiconductor down, NXP Semiconductors, both of those Apple suppliers, and then Applied Materials down 2.2%. That, of course, is a semi-cap equipment company, a leading tell on chips overall. And many saying that the chips, as you know, John, are the new transports, the tell on the economy.
We'll pick up on that story again in about 10 minutes' time. We'll get the DC angle to all of that too with Anne-Marie Horton down in Washington. Abby, thank you. About 2 minutes into this, we're up higher by 1/3 of 1% on the S&P. Energy names had a monster run through last week. We're just about positive on this morning. We're up by 1/10 of 1% or 0.2 on the session. The big banks kicking off earnings season this week. JP Morgan, Wells Fargo, Citi, Morgan Stanley, all reporting results ahead of the opening bell on Friday. That means one busy Shonali Basak. Hey, Shonali.
John, we have the moment of truth for these big banks as we see just how much money they've made in currency, fixed income, and rates markets. JP Morgan is expected still to bring in more money than a year ago at the trading business, helped by fixed income, but less money than a quarter ago. That is more than $4 billion expected in that fixed income unit. I want to also take a look at lending here because JP Morgan will really start off this conversation about bellwethers. So look at that rise in rates you're seeing, that 10-year Treasury yield, but then look at that decline you're seeing at the valuation of the S&P 500 Banks Index. That is because people don't like that inverted yield curve. They're really worried about credit quality moving forward. And about $1.2 billion worth of provisions for loan losses right now are expected for JP Morgan to report this this quarter. We'll want to get Jamie Dimon's forecast again on that economic hurricane up front. Look at those earnings estimates there, just falling. Interestingly here, you have Morgan Stanley expected to fall 26%. They are reporting Friday. They are the richest of the big five banks, trading at 1.4 times the price to book, a little more than that. Goldman Sachs has been fluctuating all year just under book value. So the question is, are these priced to perfection when you're seeing the ones that are already trading on the lower side, or is there more to come? Remember, Morgan Stanley serves wealthier clients in its wealth management unit. Does that see pressure as times get harder ahead? And then, of course, there's your favorite story on Wall Street. Do they take more markdowns when it comes to those leveraged loan portfolios, given they have been so heavily exposed to some of the biggest deals on Wall Street?
Twitter, the elephant in the room there.
Exactly.
Shanali, thank you. Looking forward to your coverage. Their own research departments forecasting some gloom. Morgan Stanley, Goldman Sachs, both publishing new research highlighting headwinds stemming from slowing demand, soaring costs, and a strengthening US dollar. Kelly Lyons has more. Hey, Kaylee.
Hey, yeah, John, both of these guys have sounded this warning before, and they're doing so once again as we get closer to this earnings season. I want to start with what David Kostin over at Goldman Sachs is saying, because he's talking about a number of different headwinds. Yes, on the cost and on the margin side, also when it comes to tax changes, and then the stronger US dollar, which has just gone from strength to strength. It's up about 14%, even more so on a year-to-date basis. And since we ended the second quarter results, it's up another about 6% or so, stronger against literally everything in G10. And that is very problematic for big multinational companies with high overseas exposure, because it makes products more expensive for international buyers, which can hit demand. And then any sales you are able to make become worth less when they're converted back into dollars. So Kostin points out that stronger greenback historically has been linked to fewer sales beats, and that will support the performance of stocks with more domestic sales relative to those with a higher proportion of foreign sales. And we can see the discrepancy in the performance of some of those equities so far on a year-to-date basis. Then moving on to Mike Wilson's argument, which again we've heard a few times now, he's essentially paying attention to the cost side, pointing out inventory, labor costs, other latent expenses that are wreaking havoc, he says, on cash flow. And he says the bear market won't be over until the deteriorating fundamental picture is more fully discounted. He thinks that looks like the S&P 500 trading at a multiple of more like 13 times forward earnings to accurately reflect that. Right now, though, John, we're trading at 15.9 times.
Kelly, more pain to come. The message from Morgan Stanley. Kelly Lyons, thank you. The message from PIMCO in their new outlook looks a little something like this. Andrew Ball was forecasting a shallow recession as his base case. The team writing, we see a downside risk for global equity markets, given starting valuations and earnings expectations that may not account for ongoing central bank tightening and increased recession risk. Andrew Balls, I'm pleased to say, joins us right now. Andrew, wonderful to catch up with you, sir. Let's start there. Recession, it's all we talk about at the moment. Are you telling me it's still not well priced?
I think shallow recessions are priced in. So if you look at fixed income markets, you look at credit markets, shallow recessions are priced in the US, in Europe. So one question there is just, how big the slowdown will be. But our asset allocation experts, our equity analysts, think that equity markets aren't pricing in enough. So a bit of a gap between credit markets and equity markets. Obviously, often the same companies involved, and so a positive view on credit versus equities, given that disparity.
And do you see the opportunity in fixed income more broadly then, right now?
Yeah, no, I think it looks quite good in terms of the fixed income outlook when you look out over the next few years, just given the starting levels of yield. So we've seen repricing across global markets. You have central bank rates and expectations higher, 10-year rates higher. Broadly, it looks kind of broadly fair to us. We think that you've seen a lot of the repricing, and that means that when you look at core bond funds, you look at a US core bond fund or a global fund, 5.5% type yields more when you are looking at credit. So as a medium-term view, that looks really attractive. In the short term, there's the uncertainty your reporters have been talking about. There's uncertainty about the economy, the Fed, central banks more broadly. So tactically, I think it's a difficult time. But looking out over the next few years, the outlooks for global bonds, US bonds, looks quite attractive here and a lot better than it was looking 1 or 2 years ago.
Andrew, can we strip out credit and look at sovereigns and almost treasuries just exclusively, just for a moment? Last time we had a big inflation shock several decades ago, it was followed by a big disinflationary bust and a multi-decade bond bull market. Is it too early to consider the destination, whether we're returning back to that kind of theme out of this one?
Well, so the starting levels are different compared with the very long-term returns to bond markets. But the levels you've seen, or look at forward rates now, so you abstract from the Fed tightening cycle, it looks pretty reasonable to us. And there's various gauges that you use. You might compare nominal growth with your nominal yield, but it looks reasonable. So I can see two-way risks to the US 10-year here. And then we have this recession risk. So worst recession risks, equity market underperformance. There's the potential for capital gains in bonds, which you wouldn't have seen 1 or 2 years ago. So the baseline looks pretty good in terms of yield levels. Broadly, we're pretty neutral on US duration here. In the next few weeks, this could go higher, this could go lower. But I think the medium-term returns, the value is there. And also, after a difficult year for returns across asset classes, and so equities have underperformed, bonds have underperformed, the potential for re-establishment of more normal patterns with bond market and equity markets not moving in the same direction as they have been doing during this atypical period.
Andrew, speaking to PIMCO over many years, typically when you anticipate a tough time, you raise cash and you get ready to be so-called liquidity providers. And I see that in the language of your outlook once again. Can you describe the moments that you actually do want to be liquidity providers and the moments you don't want anything to do with it? And can we use the gilt market of the last couple of weeks as an example? Did you step into the gilt market to provide that liquidity, Andrew?
So not in large size. So gilt markets, we've been underweight UK interest rate risk, and we've not huge positions. We've bought a little bit during this period, and I just think the level of gilts now looks quite reasonable versus treasuries. After a long kind of aberrational period, you might think where gilt yields were lower, big unpleasant adjustment, but we now see pretty reasonable levels for gilts. And so and more broadly, I think when you look at high quality duration, high quality corporate credit, you can think about currencies over time. There's a lot of good potential trades to do as you get some clarity on the Fed cycle, the global central bank cycle. At the moment, as you said, we think it's right to be pretty careful there. Look at the volatility in equity markets last week. There's a lot of uncertainty about this point in the cycle, but over time, if you go into this sort of slowdown, this sort of recession well prepared, then you've got the opportunity to add high quality assets at cheaper prices, take advantage of dislocations, be liquidity providers, as you said.
Is the Italian 10-year part of that story, Andrew?
So we've been underweight Italy. You have seen significant moves in European fixed income this year. The level of the moves in bunds, for example, given what's happened with treasuries, a bigger move in terms of bunds or the beta of bunds to treasuries than you would normally anticipate. And in that environment, the higher beta assets are going to underperform. So Italy has done that. We've tended to be underweight Italy during a period where the ECB is tightening on the basis of this high beta nature of the Italian market. I think it's becoming more interesting. You have a lot of political risk and uncertainty there, but I think over the weeks we'll get more comfort in terms of the political framework. So tactically underweight, but I think with a medium-term view, you could be positive there. And it's going to be interesting the extent to which the Europeans are cooperative in terms of the energy price shock. I mean, is there the potential for common bond issuance in Europe as we saw during the COVID period? I think if we start to get the sense that could happen, that's a real positive, I think, in terms of Europe and the medium-term outlook.
Well, let's dig deeper in Europe then. Does your view on the sovereign, to what extent does that shape your view on the underlying credit of those countries, so let's say Italy, and let's say corporate credit, bank credit. Andrew, does your view on the sovereign shape your view on bank credit in the same way it did maybe 8, 9, 10 years ago?
Yeah, so I think banks, you always look at the relationship with the sovereign. More generally with industrials, there's more of a debate, but I think that the level of yield of the sovereign is very important. In general, we think that it's better to be in US credit. So we tend to be underweight European corporate credit, overweight versus that in the US in terms of industrials, and I think that makes sense. The Russia shock energy, this is much more of a European event, much more uncertainty in Europe. I think European financials, if you're at the higher quality part of the market, I think they look fine. I think they look relatively attractive. But at a time when you can find good value across the board, there's no reason to go down in quality. You can stick with the higher quality names and sectors.
Andrew, I wanted to finish on a question that I explored with Rick Reeder of BlackRock on Friday. I'd love your view on it too. Andrew, we've just had a decade of QE, trillions of dollars of it. We've had negative rates at central banks like the ECB, the S&P, and elsewhere, and we've seen those negative rates captured in sovereign debt markets and corporate debt markets as well. We've blown that up in 12 months. And Andrew, all I hear from fixed income strategists, people who run portfolios in fixed income, is that there's resilience in credit, that things will be okay, that we've done a lot of work with balance sheets, we've pushed out maturity walls into the future. Andrew, do you think we've fully realised the negative consequences associated with blowing up a decade's worth of zero interest rates?
Well, I think there's 2 points I'd like to make there. So the first point is I think that you do have significant improvement across credit markets, balance sheets, greater resilience. And so I think that is right. And we think that in the environment of shallow recession, that credit markets are broadly priced for that sort of outcome. But there's a risk of deeper than expected recession, particularly I think in Europe, given the proximity to Russia and the energy issue. So in the medium term, I think there's value. In the short term, tactically be careful there. So I think that's the point you want to make. Medium term, the positive picture, but there is the risk of greater than expected recession. And related to this, and again, you saw this push and pull last week with equity markets. Inflation remains a significant problem across markets. The extent to which central banks are going to be forced higher than is currently priced in is something that you need to be very clear about. So with credit markets, we would make a distinction between long-term investments going in to buy cheaper assets where you're high in the capital structure, where you are very, very default remote, but being careful. There's no reason for us to go down in quality with cuspier credits at this stage of the cycle.
Hey, Andrew, wonderful to catch up. Enjoyed reading the outlook. Andrew Balls there of PIMCO. Coming up on this program, the US imposing fresh technology curbs on China.
Companies are investing in America, and we're all making sure government delivers. The infrastructure law, the Chips and Science Act.
That conversation up next. You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
What are the moonshots at Amazon that are capturing most of your time and attention?
Well, you know, we have a unique way that we look at big new investments. And I'm not sure it's right or wrong. It just happens to be our way. And we ask ourselves when we're considering something 4 questions. We ask, if it's successful, can it be big and move the needle at Amazon? Is it being well served today? Do we have a differentiated approach? And do we have competence there? And if not, can we acquire quickly? And if we like the answer to those questions, we'll go pursue it with a single-threaded team that isn't distracted by the rest of the business.
When it comes to the stock, it has fallen significantly. Do you think investors are missing something, or has tech just been overvalued?
I have never tried to predict what the stock's going to do. And any time I've tried to a little bit, I've been wrong. I do really believe that in the short term, the stock market tends to be a voting machine. In the long term, it tends to be a weighing machine. We have a concept we talk about a lot at Amazon, inputs and outputs, and the ultimate output for a company is share price, and then other big outputs are free cash flow or profit or revenue. You can't really manage the outputs. You have to manage at the input level, and that's where we spend all our time. And so if you do the right things for the business long term, things tend to work out. I think we've had very good returns for investors, and I expect that to be true again.
Person who now looking at a career, would you recommend a Wall Street career today?
There are not many jobs you can have as a young individual where you're always learning.
We celebrate workers. We're the backbone of the economy of this country. Workers in Syracuse, where the company Micron is investing $100 billion to manufacture computer chips, the biggest investment of its kind in America, biggest investment ever in the world. Companies are investing in America, and we're all making sure government delivers. The infrastructure law, the CHIPS and Science Act.
The Biden administration unveiling new restrictions on tech exports to China, the latest curbs weighing on global chip stocks. The Commerce Department writing in a statement, these updates will restrict the PBOC's ability to both purchase and manufacture certain high-end chips used in military applications and build on prior policies. Kelly Lyons in New York, AMH down in D.C. Anne-Marie, the latest.
What we're hearing from the Biden administration, Jonathan, is not just this makes sense for the administration in their domestic push after the CHIPS Act this summer, but really what they're trying to do is thwart China's capability, one in the semiconductor industry, but also in their military capabilities. Let me give you a little bit more of a statement from the Commerce Secretary and Assistant Commerce Secretary for Export Controls on Friday. China has poured resources into developing supercomputing capabilities. It goes on. It is using these capabilities to monitor, track, and surveil their own citizens and fuel its military modernization. Now, depending how much this is impacted in terms of the controls on what sectors, which companies, and how far they go, it can reach, Jonathan, a broad scope, whether it's EVs, the military, aerospace, and smartphones. But the big question is, what's the scope going to look like?
And Kaylee, pretty clear how this is playing out in the market.
Yeah, in that chip stocks are down really across the world. It started in Asia overnight, and you're seeing those names under pressure a few minutes into trading here in the U.S. as well. An analyst at Bernstein, for example, saying that this is a further escalation, revokes potentially, or could evoke retaliation from China. Morgan Stanley saying the broadened restrictions could be disruptive and create supply chain issues for companies like Intel and AMD. And Citi saying Intel, AMD, Lam Research all could see between 5 and 10% of their sales impacted by these new rules. And that could, of course, drag on their ultimate earnings, which already weren't in a great place. We've had a series of warnings from semiconductor companies over the last few weeks about plummeting demand. And then, of course, in Asia, you add on these new cocktail of factors for the chip space, 2 regulatory pressures from Beijing and an economy hit by COVID-0, which is all why we have seen the Hang Seng Tech Index down about 60% since March of last year, drastically underperforming tech peers in regions like the U.S. and Europe. It's been absolutely brutal, John.
Kelly Lyons, thank you. Wonderful work. To AMH down in D.C. Anne-Marie. Thank you very much. Equities down about 0.2% on the S&P. On the Nasdaq, we're down by 0.6% on the S&P, looking at a fourth day of losses. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. Live from New York, this is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
"25 minutes into the session, we are down across the board now on the S&P. We're down for a fourth straight session. We're off by about 1/3 of 1%. On the Nasdaq 100, we're down by 3/4 of 1%. A little bit heavier in the last 25 minutes or so, rolling over in the equity market. That's the price action. Let's get to your trading diary. Fed Vice Chair Lel Brainerd delivering remarks at 1 p.m. Eastern. A host of Fed Speak throughout the week with Mester, Kashgari, Barr and Bauman all on deck. The FOMC minutes and US PPI coming up on Wednesday. US CPI and initial jobless claims out on Thursday. Then Big Friday as well to close out the week. Retail sales in the morning alongside big bank earnings with JP Morgan, Morgan Stanley, Citi and Wells Fargo all reporting on Friday morning. Live from New York City, that does it for me. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin, not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years.
However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that They're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
Usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. And class? One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
Refer to the dictionary also, okay, and find out the new meanings, as well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, She came to the Gaulidoddi campus and then she toiled very hard for 1 year despite many problems. And today I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students so that whoever is interested in whatever activity they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change on that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, which functions as a community park, and a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. We have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20–25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insulation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well, and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. I'm using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent, like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges, or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you posted on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
If you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi, maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while, and I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So, don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is live stream shopping, one of the hottest trends in China. Every night, tens of millions of people watch live shows hosted by influencers like Thea and buy the products they recommend. On e-commerce and social apps like Taobao and Douyin, the sister app of TikTok.
我觉得已经改变了大家的购物的方式。其实各种各样的产品，哪怕你不买，你也可以来看。当然，你看了，你就有可能会买。
It's not about, only shopping. It's about the experience. It's about having fun. You got to see 3D. You got to see in some kind of action. It's almost like a theater act.
The internet craze has taken over China. By the end of 2020, the country had almost 400 million live stream shopping users. China's live stream e-commerce market has also grown dramatically, with an estimated value of $161 billion in 2020. It's becoming popular outside China as well. So, is live streaming the future of shopping? Live streaming is not a new thing. In China, it started in 2015 with the rollout of 4G. And it was first used for entertainment and socializing. Many live streamers performed for their followers or chatted to them, making money by receiving virtual currency and gifts. In the West, live streaming is mainly the domain of avid gamers. In China, it's broken into e-commerce.
China actually has a very big e-commerce empire, so it uses these super apps, what we call, that you have payment, you have search of information, you have recommendation system, and you have huge amount of goods available on the platform, and as well as a lot of consumers. So with this advantage, they merge these features of live streaming to make the influencers actually sell goods.
Here is a perfect choice. Nice neutrals, beautiful print, nothing overwhelming, and the warmth and comfort of flannel. This is item.
Traditional TV shopping involves a one-way direction, whereby a host introduces a product, demonstrates certain things, and say, call this number or something. But live stream shopping is live. That in itself is a very, very big difference. It causes different psychology. And live stream shopping is a very entertaining way of actually engaging someone else.
When you shop, actually, this live streaming video will continue. It will minimize into a corner, and you can buy the items and pay all on the same app. And after that, the live streaming screen will just enlarge by itself, and the promoter will come back to screen. So it's very convenient.
Taobao, one of China's biggest e-commerce platforms owned by tech giant Alibaba, added a live streaming function in early 2016. In the following years, other e-commerce and social platforms like JD and Douyin also integrated this feature.
开头的时候还是有很多的挑战的，对画面的这个流畅，然后是否能够很真实的去还原商品，它其实在这个上面是有很高的这个门槛跟技术的这个卡口在的。
不管是我们的这个用户的接受度，还是商家的这个上手的这个难度都很高。但是这几年下来，基本上难点在不断被突破的。
Over $70 billion worth of goods was sold via live stream on Taobao in the year through March 2021. Latest surveys show that over 60% of live stream users in China were watching shopping shows, and over 65% of them shopped at least once via live stream. In 2020, live stream shopping got a huge boost during the pandemic, when millions of people were in lockdown and many retailers were pushed online.
People, during the lockdown, felt like there's a need for more social interactions. This live platform creates an interesting kind of environment that gives people the sense that I'm actually interacting with you. And then live stream shopping brings in a lot more variety of things that people could buy and satisfy, the sense of like losing control, especially during the pandemic.
At the heart of this craze are the top influencers who have tens of millions of followers and sell products worth millions of dollars every night. They often use their star power to get bargains from retailers, which in turn boosts their own sales and influence.
So if you think about China's live streaming, you have to know the king and queen of the influencers. The queen of live streaming, Via, she is actually having the biggest viewership and the biggest sales volume for a long time on Taobao platform. She can sell everything from like Gucci sunglasses, lipsticks, homes, and cars. One time she offered her followers to go on a Tesla ride with her, and she even, for once, sold a rocket launch in her live streaming room for 40 million yuan. The king would be Li Jiaqi, more widely known as Lipstick's brother. He used to be a cosmetic sales before he turned into live streaming e-commerce, and he knows a lot about the cosmetics. So he's the one that will actually put the lipsticks on himself when he's on the show.
Top live streamers like Via and Li Jiaqi have become celebrities in China and can earn millions of dollars a year. Although not everyone can be as popular, mid-ranking live streamers like Tiffany still earn a good income through sales commissions.
如果说单从收入方面来讲的话，那主播的收入是比普通的工作要高很多。但是呢，主播这个工作时刻对身体，包括对精神都有很大的一个考验的。就是每天需要集中精力，然后长达5-6个小时，这种状态是很累的。而且这5-6个小时的话，你是脑子是不停的，然后嘴巴是不停的，然后手也是不停的，眼睛也是不停的。像我们做主播，不是说单一的只做直播一件事情，然后还会有选品的一些工作，然后还会有一些其他的事情排在里面，其实是没有个人生活的。那我觉得增强粉丝影响力的话，不是说某一件事情。可能今天做了什么事情你就增大了影响力，而是每天不断的内容的输出，粉丝不断的可能对你的了解，慢慢的信任你。
没有芝麻酱的味道，如果吃不习惯的话就慎买。
A lot of successful live streamers are generally very good at communication. They're very good at articulating very simply what a product does, what a product doesn't do. In order for them to sell, they need to be trustworthy and appear trustworthy, and they need to show in some ways that they're authentic, right? So for Via and Li Jiaqi, they are able to articulate that quite a bit through their body language, through what they say. For example, Li Jiaqi will always sometimes say bad things about certain products because to him that's his honest opinion, and sometimes people want to hear that. And so they seem very credible, they seem very trustworthy, and don't forget, they're also very entertaining and very interesting. If you're familiar with Li Jiaqi, he won a Guinness record for like the most lipstick applications to models in like 30 seconds. So if you're able to create a lot of buzz with interesting things that you do, people who may not want to buy lipsticks will also stream in just to watch what he does. And then from there, you might get hooked.
这就是一般女生出门的时候涂的口红的颜色。
Live streamers also use sales techniques such as limited time or supply. This sense of scarcity can often encourage viewers to buy.
The platform in itself creates and enhances some of these things because you see it live. Something we call social proof has taken over, meaning that, hey, other people are interested, other people are joining in, other people want the same product. and they add it in the chat and they ask questions and they say, oh, I want this too. What happens then? It makes the whole product even more scarce.
But it's not just influencers. Local farmers, luxury brands, even mutual funds have also started their own live stream shows.
Working with very top-tier live streamers can be risky. It's not necessary that the benefits will end up with the brand. So we see company executives opening their own shows, and we see like P&G have their own sales room which runs shows every day as well. We also have like local governors in like small towns to sell their agricultural products. So the live streaming is definitely transformed the way product owners can think about how to reach their consumers, and it enables a lot of players to actually sell.
Live stream shopping is going global. Merchants in Southeast Asia have embraced this trend. And in the West, Amazon has upgraded its live streaming function, adding interactive features like chat rooms. Companies, including Google and Facebook, are also developing and investing in technologies to integrate video and e-commerce.
直播电商它其实已经开始成为主流，它未来的发展空间跟潜力都是巨大的。
接下来大家会越来越依赖这种购物方式，会变成一个比较日常化、比较规范化的这么一个趋势。
If you look at the numbers alone, their numbers alone, Li Jiaxi's numbers or Via's numbers, you know that they can sell and you know that they can generate revenue. Are they able to sustain it over a long period of time? It depends on how innovative they are at changing some of the things that they do.
But you can't expect consumers one day turn into virtual shopping for good. There will be the nature of us that crave to go into the store, to touch the goods and actually wear it and see how it looks like and walk around in that with our friends. And those things wouldn't be replaceable with live streaming.
You could imagine that the oceans are actually the largest battery. We're storing huge amounts of energy in the oceans. The wave motion can be very deep. It can extend down several hundred meters. And once it gets to the near shore, from about 50 meters, the whole water column is moving backwards and forwards.
As we search for ways to reduce our reliance on fossil fuels, some are looking to a largely untapped potential source of renewable energy. In theory, waves off the coast of the United States alone could generate over 2 trillion kilowatt hours of electricity a year, enough to power more than half of the country.
Waves intensify and subside not as quickly as the wind, and that means that it can produce a smoother power generation curve. One of the potential advantages of wave energy is that it could act as a complementary source of power compared to other renewables on the grid if it were to be scaled up to commercial scale.
For decades, engineers have been trying to convert wave energy into electricity, but a host of technological and financial challenges have complicated their efforts.
In the years from around 2006 to 2015, there were a spate of bankruptcies in the sector, and this was largely because of a lack of kind of continuous proven projects out at sea with reliable electricity generation.
Since then, companies have been trying to develop the technologies at a steadier pace and with a smaller cash burn. But the same questions remain. Can companies develop devices and technologies that actually work? Is wave energy just a novelty or something that can become a major renewable energy source?
The sea is a very challenging environment within which to operate a power project. So seawater is corrosive and conditions are very rough. So this means that power projects don't have a very long lifetime, and it increases operating and maintenance costs.
Partly because of that, many early wave energy projects hit rough waters, such as the Palamas Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate. And that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together. people from? Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He's making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Pasi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Pasi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because members of my team were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon, I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board, and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? This is a car company. This is not the KGB.
I think it's fair to say that Rob Posse didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Harinata is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud. A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day, she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory, and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollars trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have a considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they've done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had is kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2, 3, 4.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now, once again, imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes. It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. But in a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright brothers airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial. It'll never be supplied in the quantities we need it. You know, blah, blah, blah. Now we know, let's take action. It's practical. It's implementable. Let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn their gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr. Force,
which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the projects. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Moments ago, we had the Dow Jones Industrial Average turn positive. In fact, right now we have got the Dow higher by 1 point. We are well off session lows. Stocks, though, the S&P down as investors assess the potential for policy tightening and geopolitical risk taking their toll on corporate earnings and economic growth. The S&P is down 13, a drop now of 0.4%. NASDAQ down 62, drop there of 0.6%. Key takeaway, though, well off session lows, the Dow now fluctuating between gains and losses. No bond market trading today. We've got spot gold down 1.5%, $16.69 the ounce, while West Texas Intermediate crude down 0.8%, $91.93 a barrel. As for the economic backdrop and what it means for the Federal Reserve, Esty Dweck is Chief Investment Officer at Flowbank.
We are seeing tentative cracks in the labor market, not quite in the non-farm payrolls, but the jolts finally came down a little bit. We're seeing some softening in growth, but at the same time, consumption seems to be holding up pretty well. And as we said, unemployment is holding up. So far, a decent mix for the Fed. But if inflation doesn't come down over the next couple of months, they're going to continue to tighten pretty aggressively, and that could definitely have pretty bad effects for 2023.
Shares of semiconductor companies are trading lower. The industry is selling off globally after fresh U.S. curbs on China's access to American technology added to a disappointing start to the earnings season, stoking concern that the industry's downturn is far from over. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down now by 3%. Among chip names, AMD, which you recall plunged 14% on Friday, down now 0.3%. Intel down 1.1%. NVIDIA lower by 2.8%. Recapping S&P down 0.4. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, strap yourself in, everybody, because it is going to be quite a week.
I'm ready.
Are you ready?
Seatbelts are fastened, yeah.
Man. All right, it's Monday, October 10th, 2022. Carol Masser, Tim Stenovic, live in our Bloomberg Interactive Broker studio. We are streaming on YouTube, and it is a jam-packed week. We've got Fed minutes coming, big bank earnings. We've got reads on retail and that all-important inflation. And once again, we've got stocks bouncing around. They're lower, but they're off their worst levels.
Yeah, we just heard the numbers from Charlie, but they're worth repeating. The S&P 500 off its lowest, but still down 0.4%. The Dow flat right now, and the NASDAQ down 0.6%.
It's rougher, though, if you're a chip stock. We're going to talk about the semiconductor names because President Biden on Friday, new technology curbs on China when it comes to technology, specifically in that semi space. So we're going to talk about the impact and what it means.
All right, we also got the most powerful buyers when it comes to U.S. Treasuries. They are all bailing at once. A great story there.
Absolutely. Plus, an expert on Vladimir Putin on his latest aggressions and threats.
And I saw this cross last night, and I thought to myself, Shri definitely wrote this story. So we got a great one with him, an exclusive. It's about Goldman Sachs domination and Reese Witherspoon all in it. We knew we had to do it, Carol.
What? Legally Blonde? She can't fix it? Okay, that's the story. And then we're going to get into Divided We Fall, why consensus matters by someone who had a front seat to the ups and downs of U.S. economic and social policy for nearly 6 decades. You will certainly know her name. All right, first up, let's get to the Market Drivers Report. Let's set your business week agenda on, it's Monday, and it is fast and furious. Kriti Gupta, anchor and markets correspondent at Bloomberg News, here in our Interactive Brokers studio, along with Gina Martin-Adams, chief equity strategist at Bloomberg Intelligence, on the phone from New Jersey. Let's kick it off with you, though, Kriti. We're, several hours well into today's trade, just a few hours away from the close. What sticks out for you in the trade today?
Well, I think it's the move that you saw in the last, I want to say, couple of minutes. And this is a move that you've been seeing, I want to say, for the last 30 minutes or so. The S&P 500 was down almost 1% at 1 o'clock, and then kind of made a turnaround. And if you actually were to look cross-asset, we know the bond market is closed, so the volume is already a little bit light when you aren't able to make those kind of cross-asset correlations, especially right now when inflation and the Federal Reserve is kind of dictating the moves. But take a look at the dollar, which kind of serves, at least in my mind, as a little bit of a proxy for what the bond market is going to be doing, given that in the past few weeks, months, years, as you see yields move up, the dollar follows as well. Well, the dollar has been pairing some of its gain, or for the session, it's only up now 0.2%. But with that move lower in the dollar, the stock market paired some of its losses. So to me, it kind of feels like it's very sensitive to the currency picture, at least on an intraday basis.
Hey, Gina Martin Adams, come on in here and give us your impressions, not just of today, but also what we got to watch for when it comes to earnings season, because you and your team have a great no doubt about mega caps for capitulation coming this earnings season.
Yeah, thank you. And I think pretty much hit today's trade on the nose. The only thing I would add is just the technicals. The market did go back and test its most recent low hit on September 30th and bounced off of that low. So clearly some buyers jumped in back at the recent lows that we made in September. In terms of the earnings outlook, the bar looks pretty low, frankly, for the third quarter specifically, but I don't know that the investor base cares too much about the third quarter. What they really care about is what's coming into 2023, and there's some really intriguing things in the consensus analyst outlook anyway that really are questionable. The first is really what's happening with the mega cap stocks and with earnings underneath the headline, because what is expected to happen in 2023 is that ex-energy earnings are actually supposed to start to accelerate next year in the face of a declining sort of outlook for broader economic growth and a deteriorating outlook for sort of momentum in the economy. To have that sort of turnaround pending in consensus is a bit of a disconnect. So I think we've got to see that disconnect close over the course of earnings season. And much of that turnaround is anticipated to come from the big mega cap stocks, where many investors have clearly concentrated their bets, where valuations are still very, very high relative to the rest of the market. There's still this sort of undying faith that the tech companies can really pull us through into 2023.
So this is, Gina, when you talk about this disconnect gap closing, it's not a case of the outlook getting better, but rather those valuations coming down to reality.
Yeah, I think that's a lot of it, Carol, and the valuations really suggest what is in consensus is a possibility, right? If the consensus thinks that we're going to see an earnings turnaround in 2023, valuations may be anticipating that earnings turnaround, or at least suggesting that any weakness that is exhibited in this group, as has been the case for the last couple of quarters, is somewhat temporary. So will it actually be temporary is a huge question going into the next couple of weeks.
All right, well, speaking of the next couple of weeks, before we get to the next 2 weeks, I want to stick with this 1 week, Creedy, and give us an idea of Fed minutes, big bank earnings, retail, and then of that inflation report that we get, CPI. We're still, expecting 8.1%. So
8.1%.
Yeah, I mean, of all the things that I just mentioned there, which one is the most important?
It feels like a no-brainer to say CPI, but I'm going to just have to agree with actually a guest who is just on my show just a second ago, Blorina Arucci, the T. Rowe Price chief U.S. economist, and she said it was actually retail sales that was going to be the bigger mover.
What did Vince tell us last week? He said inflation was more important than earnings.
Yeah, well, everybody's got a view, but I think it will tell us about the consumer, who's been so important in keeping some economic momentum going.
Right, especially in the context of, and Paul Sweeney mentioned this earlier today, but especially in the context of the fact that so many retailers are discounting their inventory by so much. You want to make sure that you still have that retail buying momentum, because at the end of the day, net, you really want to make sure that this holiday season specifically is going to still be a growth period for the U.S. economy. And to Gina's point, it feels like there's so many things that are kind of primed for a bounce back now. I think retail sales would be a good way to hook your narrative onto that.
I just kicked something under my desk. I'm really sorry.
There's a whole group.
We're going to talk with the folks over at Adobe about the upcoming retail holiday season. There's already a story in the Bloomberg about many retailers already out trying to pump up the sales ahead of holidays. Yeah. Hey, Gina, just 20 seconds left here for big bank earnings in particular. Any thoughts we should think about real quickly?
Oh, I think the market's going to be looking at these earnings pretty carefully, in particular loan loss reserves, what's happening with actual loan extensions, what's happening with the deposit rates as well, and sort of the competitive landscape with money market accounts. How are they losing these assets and not increasing deposit rates is a huge question on investors' minds.
Yeah, these are all really important issues. Guys, great setup for what will be a very busy week. Our thanks to Kriti Gupta, anchor and markets correspondent at Bloomberg here in our studio. Gina Martin Adams, chief equity strategist at Bloomberg Intelligence, on the phone from New Jersey.
All right. Well, let's get to Washington, D.C. now. From New Jersey, from New York City, we go. Nancy Lyons is standing by in our D.C. newsroom there with an update when it comes to world and national news. Hey there, Nance.
Thanks, Tim. Russian President Vladimir Putin is warning of more attacks against civilian targets in Ukraine. That's if Ukraine continues what he calls terrorist acts on Russian territory, a likely reference to a recent explosion that damaged a major bridge from Russia to Crimea. No one has claimed responsibility for that. Ukraine, meanwhile, is pressuring the U.S. and Europe to provide more air defense missiles after Russia's missile barrage today. Bloomberg's Anne-Marie Hordern with more.
I spoke to the Ukrainian Foreign Ministry this morning. What they are seeking for from the international community is more of these types of air defense missile systems, as well as they want the international community to label Russia a terrorist state.
Bloomberg's Anne-Marie Hordern reports delivery and training on those air defense systems could take weeks. A pro-Russian group is claiming credit for a series of disruptions that temporarily knocked offline the websites of some U.S. airports. The group, called KillNet, has engaged in a series of cyber attacks in recent months against Western targets, including incidents that officials say temporarily sent some state government websites offline last week. Well, the man accused of driving an SUV into a Christmas parade last year in Wisconsin apologized to the court today for his behavior during the trial. Darrell Brooks, who is representing himself, had to be removed from the courtroom last week after repeated outbursts.
I would like to issue the court an apology for me.
Brooks is on trial for killing 6 and injuring dozens of others in that attack. During today's hearing, Brooks blamed his actions last week on the stress of the trial, and he promised to do better moving forward. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
That is Nancy Lyons there, of course, in our 99.1 newsroom in Washington, D.C. with World and National News. Nancy touched on this, and we're going to get deeper into the latest aggression by Russia into Ukraine and the threats that have been coming out also from the president of Russia. But this story, we want to dig a little bit deeper into it, about a pro-Russian hacktivist group is claiming credit for a series of disruptions that temporarily knocked the websites of some U.S. airports offline.
Yeah, the group is called KillNet. It's engaged in a series of cyber attacks in recent months against Western targets, including incidents that temporarily rendered some state government websites offline last week. That's according to cybersecurity experts. So Los Angeles International Airport, LAX, issuing a statement saying that its website was partially disrupted and that the interruption was limited to portions of the public-facing website. There were no disruptions to internal airport systems, nor were there any operational difficulties, according to the statement. So that's pretty important there.
Absolutely. And it's not just LAX. Site for LaGuardia Airport was also affected, in addition to Des Moines International Airport. That was coming from ABC News. Websites for O'Hare and Midway airports in Chicago were offline today, according to a statement from the Chicago Department of Aviation, but no airport operations were affected. So interesting. I don't know if you saw, okay, you know how I like to do this.
I know what you're going to say, 60 Minutes last night?
Did you watch?
No, but I saw tweets about it.
There was a great piece on Taiwan specifically and the relationship tension filled relationship with China. And of course, we've had Nancy Pelosi visit Taiwan recently, the president making some comments about defending Taiwan. But specifically, there was a segment on how much cyber attacks are coming from China specifically, and we were watching a screen of just in real time the cyber attacks that come into Taiwan from China.
Well, think about it from the perspective of just your own personal finances and to what extent this information about.
Give me a heart attack.
Well, this is true, right? We're paperless in so many different settings right now. So who's going to keep track of this stuff if these systems are hacked? Again, these were public facing. Exactly. Maybe.
Yeah, it's the other warfare, right? It's not just about guns and artillery and missiles. It's also about cyber warfare. We're going to talk more in just a moment.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow back in the red, down 71 points now, down 0.2%. Stocks, however, have paired earlier losses as investors weigh concerns about the Fed's monetary tightening trajectory and its impact on corporate earnings. The S&P 500 index is down 24, a decline now of 0.7%. NASDAQ is down 102 points, a drop there of 0.6%. No bond market trading today because of the Columbus Day holiday. The Dow, the S&P, NASDAQ all lower. We've got gold down 1.5%, $16.69 the ounce. West Texas Intermediate crude oil is down 1.2%, $91.56 a barrel. Bottom line here, down day for the Dow, the S&P, and NASDAQ. S&P lower by 0.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You are listening and watching Bloomberg Business Week on this Monday. While geopolitical tensions heightening following comments by President Vladimir Putin, who threatened further missile attacks on Ukraine after Russia hit Kyiv and other cities in the most intense barrage of strikes since the first days of its invasion, marking a dangerous new escalation in the war that is going on much longer than everybody anticipated.
At the same time, a warning from President Biden, a fundraiser in recent days, sending shivers down many people's spines around the world. We've got a great guest with us this afternoon. Angela Sten is Senior Advisor for the Center for Eurasian, Russian, and East European Studies. She joins us on the phone from Washington, D.C. Her most recent book, Putin's World, Russia Against the West and with the Rest. Angela, really good to have you with us this afternoon. Where do we begin with the most recent action in Crimea, in Russia, and of course in Ukraine as well, in terms of how this conflict could spread even beyond those borders?
So Putin obviously has escalated the conflict since the attack on the bridge to Crimea a couple of days ago, and there was this really indiscriminate bombing all around Ukraine, major cities losing all their electricity and water, and some of them still in the dark, so real attacks on infrastructure, but also indiscriminate attacks on civilians. Children's playgrounds blown up, shopping malls blown up. You know, these aren't military targets. So this is Putin's way of saying, we're going to really fight back. He's just appointed a new commander of all the troops and the Ukraine operation, a man called General Surovikin, who has a reputation for being particularly brutal from the Syrian civil war and down. He's even served time in jail, and he, didn't waste any time, having just been appointed after Putin was criticized for not doing enough in Ukraine, and clearly this is his first act. And as Putin has warned, this isn't the last one.
So what does that mean? How do you interpret that? How would you advise world leaders with comments like that?
Well, I think they have to expect more of these indiscriminate bombings. However, we do know that Russia does not have an infinite supply of these long-range weapons, and they may run out of them sooner maybe than they themselves want to admit. I think world leaders have to, redouble their efforts to support Ukraine. There is going to be more pressure from some people on the Biden administration to supply even more lethal and long-range weapons to Ukraine, things that President Zelensky has been asking for and no doubt will ask for again when he is beamed into this emergency G7 summit to discuss what's happening. So I think that's where the emphasis will be, and there will have to be a discussion. Is there more that we could be doing, particularly with air defenses, to help the Ukrainians fend off these attacks?
Angela, as Tim mentioned, your latest book is on Vladimir Putin, Putin's World, Russia Against the West and with the Rest. Get inside Putin's head as much as you can for us and tell the world what we need to be nervous about right now.
Well, the Russians aren't winning this war. I think Putin's grip on power is now weaker than it's been at any time since he came to power 22 years ago. He just celebrated his 70th birthday. He thought he was going to leave this legacy of conquering Ukraine. So he is, from his point of view, cornered. He's under attack from people who are more hawkish than he is to show that Russia can win. So I think we are at a dangerous moment. I think we can expect more escalation, at least in a conventional way, I'm less concerned about these nuclear threats, although, President Biden, as you said, alluded to them before, because Russia can do an enormous amount of damage to Ukraine without going nuclear.
Why are you less concerned about the nuclear threat here?
Because it wouldn't, using a tactical nuclear weapon, it would set the Ukrainians back a bit, but it wouldn't really accomplish the kind of territorial gains that Putin is trying to make. And it would really, by breaking a taboo like that, it would alienate a number of countries that up till now have supported or been neutral.
Would it begin World War III?
Well, it would begin with World War III if it escalated from one tactical nuclear weapon to strategic nuclear weapons, the ones that can reach the United States. And some people say we've never had a situation where someone's used a tactical nuclear weapon, but in fact it would escalate quite quickly, and then that would be World War III.
Shivers up my spine just by even talking about this. Hey, Angela, before we got into this interview, Tim and I talked about a pro-Russian hacktivist group claiming credit for a series of disruptions that temporarily knocked the websites of some U.S. airports offline. It's traditional warfare, if you will, using, ground war, missiles, and so on, but it's also a cyber war. How do we need to think about that as Russia, as you said, President Putin certainly feels cornered at this point?
So I think we should expect, in fact, people have wondered why there haven't been more of these kind of cyber attacks. The German train system in the last couple of days was suddenly disrupted in northern Germany. Who did that? So I think these kind of asymmetric cyber attacks are probably what's going to happen in the future, and we have to be well prepared for that, and we have to know how to strike back against that too.
What does this mean potentially for Taiwan, China, and everyone else?
Well, I think for the Chinese, they're watching what's happening in Ukraine, and they're seeing how the Ukrainians are fighting back. So they might wonder how the Taiwanese, also equipped with American weaponry, might fight back. And then they're watching the sanctions that were imposed on Russia, that presumably those kind of sanctions would be imposed on China. So I don't think what's happening is going to embolden China. I think it would give them pause for thought before they did anything.
All right, 30 seconds left, Angela. A potential off-ramp for Vladimir Putin. What could it be?
I don't see an off-ramp at the moment because Putin wants the whole of Ukraine. So there's nothing at the moment, I think, that would work as an off-ramp, unless Ukraine were willing to cede an enormous amount of its territory, which it's not willing to do.
Is it just Ukraine, or is there more in his sights? 10 seconds.
Oh, yeah. I mean, he would like to go further than Ukraine, and that was his goal at the beginning.
Yeah.
It doesn't look as if that's very likely now.
So appreciate you. Angela Stent, Senior Advisor, Center for Eurasian, Russian, and East European Studies. Check out her book, Putin's World, Russia Against the West, and With the Rest. You are listening to Bloomberg Business Week on Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, folks, we're going to get to one of the most read stories on the terminal involving Goldman Sachs.